How's everyone doing? Welcome to the Banker Next Door. You are in the strategy room here on this Saturday night, July 18th, 2026. It's so good to be back here with everyone. I know I can't believe it's been 3 weeks, man. 3 weeks went by insanely fast. Now you might be wondering, well, what was going on the 3 weeks? Well, I was on vacation for a couple of weeks, and as you can notice with the tan that I don't have, the 5 extra pounds I put on all the eating, yeah, it was gross. Great. It was fun. It was a great time. But yeah, so it was good couple of weeks off, some time to re-energize, get kind of back in the groove with everything. But now I'm back. I'm back and I'm rested. I'm ready to go. And as usual, have a great program here for everyone tonight. We're going to be talking about Kevin Warsh. Gave his first congressional testimony this week. We're going to talk about what happened in that. What were some of the big key takeaways there? What were some thoughts from different people as we walk away from that? I got a lot of economic data. We're going to be looking at inflation data, the CCP or the CPI, the PPI. What happened? Inflation numbers went down this last month, but what does that mean? Is that a good thing? Is that a bad thing? Will those numbers go back up in the months ahead? We'll take a look at all that. We're going to take a look at some job numbers. We're also going to take a look at bank earnings. Earnings season kicked off for the second quarter, and banks had blowout earnings numbers, just absolutely amazing numbers for banks across the board. So this is just really good news for the financial system here in America. That just the banks just doing very, very well at the moment. We're going to continue the AI conversation a little bit. I've got a bunch of different articles there with that. We've got Apple suing OpenAI. OpenAI's potential IPOs in a little bit of danger. Elon Musk dealing with data center issues out there in New Mexico. But TCM or TSMC, rather, the chip manufacturer, seeing a lot of success out there in Arizona, is basically going to massively increase their investment in Arizona. So we're going to be talking and looking at all that tonight. Also have a lot of other great stuff to share with everybody. As usual, the economic indicators. We're going to be talking some bank news. We're going to be talking about a whole bunch of different things going on. So strap in. We got a couple hours here. We're going to get to all this stuff. So I am going to kick it off here as I usually do. Now, by looking at the U.S. debt clock here, now the U.S. national debt has surged up to $39.4 trillion. And we are going to go over 40 trillion in the national debt in the next, I would say probably 3 to 4 months, probably 90 to 100 days. We will be over $40 trillion. Now, what does that debt equate to? That equates to a debt per citizen of $114,000, and that equates to a debt per taxpayer of $356,000. I know you've got $356,000 sitting around in your couch just like I do, right? Sure. U.S. federal spending is up to $7.2 trillion. The U.S. federal budget deficit is at $1.6 trillion. The debt to GDP, now this is the federal debt to GDP, is at 122%. Now, you may have seen in the news recently that the consumer debt to GDP just went over 100%. And we are very much with just the absurd amount of debt that America has, both on the consumer side and on the federal government side. We are definitely heading into the danger zone. We are in a very dangerous situation debt-wise. The interest on the national debt, you can see here kind of in the middle of the screen here, just the interest alone to service that national debt is over $1 trillion. The defense spending is at $943 billion. But with news this week of the continuing war in Iran, the Republican Party just requested yet more funds to fund that war, which means that defense budget number is going to be going up. Credit card debt, which we're going to be talking about credit card delinquency a little bit later in the show, is up to a little over $1.3 trillion. That equates to a debt per cardholder of $8,334. So again, credit card debt, but you compound that with auto loans, I think around 1.6 trillion, with student loan debt around 1.6 trillion, mortgage debt. Mortgage debt, nine trillion, no, higher than that, probably like 13 or 14 trillion dollars in mortgage debt. So you add all these things up, and that's where you get the compounding of the debt out there right now. So, all right, let's take a look at some other things. Stocks obviously down for the week. Obviously, the continuation of the Iran war did not help anything this week. Really took a beating on the stocks and stuff like that. Let's take a look in at. We'll look at residential mortgage rates in a second, but let's take a look in at interest rates. Obviously, the 30-year bond going back over 5%, not a good thing there. I've talked about that ad nauseum in months over the last 6-7 months. We definitely wanted to keep that 30-year bond, try to keep it under 5%. The 10-year Treasury note is back up to 4.550 rates. Again, all these rates going back up a little bit this week. With the escalation over there in Iran after things were looking good there for a couple weeks, and people were really getting hopeful that things were going to kind of wind down there. Now the 2-year note is at 4.183, again increasing. And then on the shorter side, we got the 1-year bill at the 3.995, the 6-month bill at the 3.921, the 3-month bill at 3.801, and the 1-month bill at 3.693. All beginning to get a little bit of breathing room there. Like I said, one of the interesting things that I had noted a few months ago is the fact that all of those short-term bills were really trading within a fraction of a percentage of each other, which was very unusual. Not something that you see very often. So, all right. So with all of these rates here going up this week, what does that necessarily mean for mortgage rates? Well, let's take a look at mortgage rates today. So, according to average mortgage rates from the Zillow Lender Marketplace, the current 30-year fixed rate fell by 4 basis points to 6.48%. The 15-year fixed rate fell by 5 basis points to 5.90, and the 5/1 ARM fell by 29 basis points to 6.46%. Now, interest rates this is the highest that rates have been in, probably definitely in the last, 6-7 months. So we've got the 30-year fixed rate at 6.48%. Like I said, the 15-year at 5.90, 5/1 ARM at 6.46%, and the 30-year VA mortgage at 5.93. And then we take a look at mortgage refinance rates. Not tremendously different, but the 30-year fixed on a refinance is 6.48%, 15-year fixed at 5.74%, the 5/1 ARM at 6.28%, and the 30-year VA at 5.80. So, again, interest rates going back up, not where we want them to be, going in the wrong direction. And again, it's hard to say. It's hard to say because so much of this is going to be driven by what happens with Iran. If this continues to go on, it continues to escalate. These numbers obviously will not go in the right direction. So, but anyway, I want to take a look back at commodities here for just a second. So, what happened? You could see here on the chart. Basically, this is over just the last day or so here from July 17th. We're already seeing prices go up. This was yesterday, Friday. We were down at $78, and now we're up at $82 right here. But let's go back to the 5-day here. You could just see what happened here. July 13th was the Monday, and obviously the Iran escalation in the Iran conflict just kicks back off, and then we go right from $73, boom, right back up to $82. And this is the crude oil futures, and then we go to Brent crude. Wait, sorry, I got on the wrong, went too far there. Okay, and then we can see for Brent crude, go back to the 5-day and same exact thing. Back on the 13th on Monday, you're talking about $77, and now you're back up at $88. So really seeing this spike back up in the Brent crude, which means that our gas prices are all going to go right back up. They already have in some areas. They're going to continue to go up through the rest of the country. Again, not great. And then we get to this. Frequent oil draws from U.S. Strategic Reserve push old system to the breaking point. Fracturing wells, leaky pumps, and other wear and tear are straining the Gulf Coast salt caverns that make up the reserve. So, and I wanted to show everybody from this chart here. So this is the chart of U.S. crude oil stock. This is the Strategic Petroleum Reserve, the SPR. Now you can see here going back to 2021, we were at 638 million barrels. The stock was pretty much fully there. Everything was really good. Then, obviously, Joe Biden started taking from the Strategic Petroleum Reserve during his administration, particularly as he came up for reelection, really started to dip into it. And we could see it coming way down here. And we hit a low here in right around the beginning of 2024, we hit a low of about 346 million barrels. So Joe Biden basically cut the reserve in half, almost. Almost halved it. So then, Donald Trump gets into office. We start to come back up. We're coming back nicely. It's filling itself back up slowly. We get back up to 415 million barrels, and that was in March 27th of this year. And then what happens? Well, the Iran conflict really kicks off, and then we basically begin to fall off a cliff here, and now we're back down to 331 million barrels. Now, obviously, this cannot go on much longer. I mean, you cannot drain the Strategic Petroleum Reserve to next to nothing. So another 100 million barrels come out of this thing, and yeah, we're going to start to get pretty low, and that's not a good thing. That is not a good thing, not where we want to be. So I wanted to show that to everybody. Now, again, this is a concern. We got to watch this, and we got to see what happens here and where things go from there. So, but all right, anyway, now on to the news here. So I wanted to share this with everybody. This was actually from a couple days from before July 4th. I want to say this was on July 1st, but the First Bank of the United States was brought back to life to mark America's 250th birthday. I thought this was absolutely awesome. So for anybody who doesn't know the history here, the First Bank of the United States was actually the first central bank of the United States. It was a building that the central bank got its charter in 1791. It was a 20-year charter that ran until the year 1811, in which time James Madison, the fourth president of the United States, basically canceled the charter to the first central bank of the United States. Again, a lot of reasons for that. I'm not going to get into all that here, but this building eventually became, and this building's in Philadelphia. It's right down by Independence Hall, not far away. Now, this building eventually became Girard Bank. Now, obviously, Girard and the Girard family, very prominent, wealthy figures in the history of Philadelphia. But this building became a Girard Bank for many years until about, I believe it was 1950, when this building was closed, and this building had sat vacant and got dilapidated for probably about 60 something years. And it got pretty run down. And then finally, some great people in the city of Philadelphia basically decided that this building had such historical significance, major part in the economic history of the country, the history of the banking system, the beginning of the birth of the nation, and the building of our economy initially, that this building had to be saved and it had to be brought back. So it took a long time. I want to say this was been going on for probably almost 15 years to raise the money and get this back up and running. So the First Bank of the United States reopens to the public after 50 years. The restoration project received $35 million from the Great American Outdoors Act. The building will house rotating exhibits and host private events. After a ribbon cutting ceremony Wednesday, the historic building at the southwest corner of 3rd and Chestnut Streets will welcome visitors for rotating exhibits and educational programming. It will also be available to host private events. The $39 million project to restore and reopen the 120 South 3rd Street landmark has been in the works for a decade after the Independence Historical Trust raised $4.5 million in private and foundation dollars to use for design and other soft costs. The First Bank project vaulted to the front of the line to receive funding from the Great American Outdoors Act of 2020, which provides $1.9 billion annually to address and maintenance backlog at national parks. The project raised $22 million through the Great American Outdoors Act of 2023 and later increased that figure to $35 million. The building required new or upgraded windows, plumbing, HVAC, electricity, and elevators, as well as work to repair water damage to the interior. Steve Sims, superintendent of Independence National Historic Park, said the primary issue was asbestos remediation, which extended the timeline for the project. But here you can see an interior picture. I don't know that they have a picture here of the actual rotunda in the inside of the building, but it's very beautiful. It's very nice to look at. Here is a picture of the backside of the building. The first floor exhibits are going to talk about the creation of the financial system in the 1790s with Alexander Hamilton and what the first bank meant. The second floor will have room for additional exhibits as well as classrooms for educational programming. The opportunities are really tremendous to be able to connect with people in the building that was built in 1797. The Independence Historical Trust will be responsible for leasing the first bank out for events, which will help produce revenue for the building. The Park Service and Independence Historical Trust chose Chadsford's John Milner Architects, a historic preservation design and architectural firm, to rehabilitate and reimagine the First Bank building. Westchester's The Bedwell Company, a construction management firm, completed the building's restoration. So again, and to all the Independent Historical Trust, to John Burton and his whole team down there, congrats. I take my hat off to them. They just did an absolute job. Like I said, this was a long time in the making to bring this a very grand historical building back to life, bring it back to prominence, and turn it back into a museum in the city of Philadelphia. So, and John Burton actually had the honor of being my very first interview here on the channel for the podcast. So, if anybody, unfortunately, it was an interview. A lot of rookie mistakes, I'll say it that way, in that interview. So I'm hesitant to tell people to go out back and watch that. But I am hoping to be doing an interview with John again real soon to hopefully get everybody, kind of caught back up to date with all the goings ons there and what else is happening, what else his his historical association has in the works. So, but again, and I just wanted to point one thing out to everybody. On my YouTube page, if you actually go, this is my YouTube page. If you actually, my background picture, if you will, is actually the First Bank of the United States. I've actually had, believe it or not, some people have actually asked me over the years. They said, "Hey, what is that building? It looks historic. I wasn't really familiar with it." And I said, "Yes, that bank actually is the First Bank of the United States." And I have used that as my background picture, if you will, here, and not only here, but also on other, social media sites that I'm on, X and all that kind of stuff. But that is the background picture that I use and have used since I started the channel just about 3 years ago. So, yeah, again, very cool. First Bank back in action. So, all right, now another big news this week was the passing of a landmark legislation. We got the 21st Century Road to Housing Act became law on July 10th. So the new pilot programs will ease capital requirements for de novo banks. And then small community banks served 28% of surveyed small business owners. So let's scroll down here and take a look. So what are some of the things in this bill? Well, it is going to requiring federal regulators to jointly study ways to improve the growth, capital adequacy, and profitability of rural deposit institutions, and to identify regulatory barriers to these goals and to the formation of new depository institutions with a report to Congress due within 1 year of enactment. Directing the Department of the Treasury to establish a mentor protege program pairing large financial institutions with other depository institutions with the goal of enhancing their capacity to serve customers and potentially act as financial agents. Requiring the GAO, that's the Government Accountability Office, the GAO, and appropriate federal banking regulators to issue reports within specified timeframes when the FDIC invokes the systemic risk exemption, detailing causes of bank failures, regulatory action, and any management or supervision shortcomings. Establishing that custodial deposits of an insured depository institution are not considered to be brokered deposits if the total amount does not exceed 20% of an institution's total liabilities and the institution has less than $10 billion in assets. That is a very big deal. That one is very big. Raising the consolidated asset threshold from 3 billion to 6 billion for insured depository institutions to qualify for an 18-month examination cycle. Again, another very, very nice one in here. Amending the Federal Credit Union Act to revise the frequency of meetings that a federal credit union's board of directors is required to hold, requiring the CFPB and the Federal Housing Finance Agency to evaluate the impact of existing regulations that limit the points and fees that lenders can charge on qualified mortgage loans, which vary by loan limit. Now, that last detail there, that is supposed to help banks with their residential mortgage lending. We'll see how that ultimately really plays out over, say, the next couple of years. But, in theory, that is, again, is supposed to help banks with, increasing their residential mortgage lending. But like I said, we shall see. But again, huge bill that passed and is now law, and definitely some good things in there for banking. Now, the housing aspect of this whole thing, what was this thing supposed to do? This was supposed to stop hedge funds, private equity funds, a BlackRock from basically going in and buying a lot of residential mortgage properties and turning them into rental properties. That was supposed to stop this. Now, I think it technically stops it. I don't think it fully stops it. And one of the other things that is allowed in here is that those like BlackRock, for example, BlackRock would still be allowed to go and build new housing. They could build brand new housing that they can then continue to use or continue to increase their rental supply, making those new houses rental houses. So it in my mind, does this fully stop them from buying up a whole bunch of inventory and everything? In a certain respect, but not exactly. Like I said, they're still free to, if they want to just build new housing and then just rent it out, turn it into rental properties, they're free to do that. So again, we'll see how this legislation ultimately plays out over the next few years. Will it have the dramatic impact that I think a lot of them are looking for? Probably not, but we'll see. All right. Now on to Kevin Warsh. So Kevin Warsh, the new chairman of the Federal Reserve, he was up on Capitol Hill this week. He was given a bunch of testimony, and what were basically some of the big takeaways from this? So Warsh pledges Fed policy regime change to rid inflation tax on the American people. So Fed Chairman Kevin Warsh on Tuesday, in remarks he delivered to Congress this week, vowed to defeat inflation and get monetary policy right. While he promised to tackle inflation, the central bank leader said the economy is in otherwise solid shape and will reap untold benefits from artificial intelligence investments. Maybe. Like I said, hang in there with me. In about an hour, when we get to the AI conversation, yeah, maybe not. We'll see. Warsh took aim at prior Fed policy, specifically the flexible inflation targeting adopted in 2020, that central bank wasn't the first central bank to ask for a little more inflation and end up with a lot more. It was a mistake, he said. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability. Now, what's interesting about that is he says the members of our committee, meaning the FOMC, the Federal Open Markets Committee. Now, he says the members of the committee have no tolerance for persistently elevated inflation, really, because that's all you've had since 2020 is persistently elevated inflation, yet they seem to be tolerating it quite well. so, maybe they have a newfound tolerance. They have a new chair in there. They got a new leader. He's not Jerome Powell, so maybe I don't know. Maybe they found their spine. I don't know. I mean, who knows about such things, right? I have said this before. So when Alan Greenspan passed away, I did an episode on that. That's probably going back. I can't believe going back a month now. Now, when I did that episode on Alan Greenspan, one of the things that I had pointed out in there that you have to remember there's two sides of inflation. You have asset inflation and then you have price inflation. The Fed under Alan Greenspan back in the 90s decided that asset inflation, meaning the value, the cost of stocks, the value of your house, asset inflation good, price inflation bad. But they allowed the asset inflation to run and basically get, Alan Greenspan. Unfortunately for him, his legacy is bubbles. Why does he have bubbles? Why did he create bubbles? Well, because he was all about the asset inflation. He was fine with letting the value of stocks go to the moon, thus creating the dot-com bubble. Then he was fine with letting real estate run to the moon, thus creating the real estate bubble that exploded in 2007. And that, that is was the doing of Alan Greenspan. So the Fed, when you really examine it and go back to the history, the Fed has been fine with inflation for a long time. They just liked a certain kind of inflation. They liked the asset inflation, because the asset inflation, as the market's going up, houses are going up, what does that do? That creates what they call the wealth effect. Okay. In other words, people, your value of your house is going up, the value of your stocks is going up. So people feel wealthier. And the politicians and the Fed, they love that, because that means that people are happy. They're happy about the economy. They're happy the way things going. Oh, look at how fabulously wealthy I'm becoming. Even though it may only be on paper, it's like, oh yeah, my house is worth $1 million. My stocks are worth $3 million. I'm doing great. I can retire. I can pay for my kids' college education. Well, life is good. So that type of inflation by the Fed, that was fine. Okay. They never liked price inflation, because price inflation, when the price of goods and food and cars and all the other stuff that we need to get day in and day out, when that starts going up, what happens? People get very upset. They get in a bad mood. They start, wait for it, voting politicians out of office like that. Yes, that's what happens. So price inflation, very bad. Asset inflation, very good. the problem the problem that you have there is that it is very, very difficult to basically keep both types of inflation under wraps forever. Like, in other words, you can't keep asset inflation going up, like up to the moon perpetually, and keep price inflation down here next to nothing forever. It is very, very, very difficult to do that, as the Fed has found out repeatedly, time and time again, over the last 30 years, and yet they continue to keep trying to do it. So, with that being said, I find some of these comments almost laughable. The members of our committee have no tolerance for persistently elevating inflation. Really, because that's exactly what they've been doing for the last 35 years. Okay. All right. So now, but let's go on here. So, from bailouts to balance sheets, key takeaways from Warsh's first congressional hearing. We need a regime change in policy, Federal Reserve Chair Kevin Warsh tells House officials. So Federal Reserve Chairman Kevin Warsh delivered his first semi-annual monetary policy report to Congress on July 14th, speaking to lawmakers for 3 hours on a range of issues. So let's see here. What are 5 key takeaways from this? So, abolishing the inflation tax. So Warsh continued his tough talk on inflation on day one of his visit to Congress. The 63 months of inflation above target has been an unfair burden and has been a tax on the American people and businesses. We plan on getting rid of that tax. Yes. If you don't understand that, if there's one thing that you come away from for watching this channel, watching this podcast, I want you to understand this. Inflation is a tax, and it is a hidden tax. It is always been known as the hidden tax on the American people. Inflation is and inflation is probably the worst kind of tax. It is a horrible tax, because it robs people of money. With, again, usually one in a million people, they can't figure out why it's happening, how it's happening, what's going on. And that's what makes inflation so insidious. That's what makes it such a horrible hidden tax. Because, again, most people don't have the economic foundation to understand what it is, what it's happening, why it's happening. So again, and I love the sentiment here. Like, yeah, we've got to get inflation under control. We got to get it way, way down. I love it. It's just that, you know, in order to do that, like I just said about the difference between asset inflation and price inflation, The problem is, if you really want to get that price inflation down and you want to get it down next to zero, what's going to happen to asset inflation? Not that it's going to stop or it's going to go away, but it's going to come way down. So it, and that does not, if the value of my house goes from $1 million to 750, am I going to be happy about that? Not really. So again, just keep that in mind as we go through, so what does this mean, though? That means we need a regime change in policy, and we need new consideration of practices, some of which have been working, some of which haven't. The Fed has been consistently above its 2% inflation target for more than 5 years, and this has been part of the central bank's problem, Warsh noted. Since the start of the war in Iran, consumer inflation has been accelerating to its highest level since 2023. Last month, data suggests inflation could be stabilizing, and we'll get to that in just a moment. But we are not out of the woods just yet. So now let's go to the next thing. No bailouts for anyone. Under Warsh's leadership, the Fed is not going to be bailing out business. During the 2008 financial crisis, the Fed and the Treasury Department deployed a $700 billion bailout package to prevent the U.S. economy from sliding into a full-blown economic collapse. At the onset of the COVID-19 pandemic, the central bank also employed emergency measures, including 0% interest rates and balance sheet expansion. The Fed also offered emergency liquidity to financial institutions during the regional banking fiasco in 2023. The Fed also bailed out the repo market in 2019. Yeah, they always forget to mention that one. In an exchange with Rep. Brad Sherman regarding the cryptocurrency market, Warsh said the Fed would do everything we can to mitigate risks in the crypto market. The new central bank chief added that he does not want to be in a position where we're not bailing anybody out. We do not want to be in the bailout business wholesale. Now, is he right with this? Yes, he absolutely is. However, we will see if a moment comes where he is put to the test. It's easy to say this now when things are relatively okay. It's easy to say this now. When he gets put to the test, when something happens, when we have a mini banking crisis like we did in 2023, when the repo market has some kind of implosion, when the bond market starts to go on the fritz, and all of a sudden, if private credit massively blows up, and all the hedge funds come in looking for a bailout, and they're all screaming the same thing: domino effect, too big to fail. If all these hedge funds fail, then they're going to take the whole financial system down with them. We shall see whether he sticks to this or not. Like I said, it's easy to say this when things are good, not so easy when. And the problem is that under the last three Fed chiefs, under Ben Bernanke, Janet Yellen, and Jerome Powell, the three amigos, okay, they created the all bailout, all the time economy over the 17 some odd years that the three of them were in office, in the chair seat there at the Fed. So they created the all bailout, all the time economy. They effectively, in kind of rude terms, they turned Wall Street into a junkie. They turned Wall Street into a junkie, and Wall Street, they need to get their liquidity hits. And when you're not doing that, Wall Street's not going to be very happy. What is happening? And I ask you this, what's happening right now with the Fed's balance sheet? And I showed this the last live stream 3 weeks ago. The Fed's balance sheet is going back up. Why is it going back up? Oh yeah, because they're buying bonds again. So they're doing QE light at the moment. Okay, they're not astronomically large numbers, but they're pumping money via purchases into the bond market via purchases of mortgage-backed securities and treasuries right now. And they did that because Jerome Powell, he brought the balance sheet down, but in doing so, he drained all the money out of the repo market, and he thus draining money out of the liquidity out of the overall market. And now it's like, oh man, we got to start pumping some money back in. So, and that's the equity injections, and I'm talking about the injections that Wall Street needs. So if that's not happening, or if he's really serious about that, and he basically turns off that liquidity spigot, things could get dicey pretty quick. So we'll see. We'll see on this. Now, forward guidance again, how the Fed communicates with the public has been in the spotlight since Warsh's arrival. So he again expressed his opposition to forward guidance, something that the central bank is veering away from under new management. Warsh said that the objective is to get monetary policy right, and by refraining from commenting all the time, the Fed can get a better way of calling balls and strikes. If we were to share with you our every passing thought, I worry not that there's anything wrong with us, but we're human, Warsh told lawmakers. If we were to give you my projection today about what we'll do when we need in 2 weeks, what we'll do over the course of the year, we then find ourselves sort of taking information that's consistent with our priors and rejecting information that's inconsistent. So communication and forward guidance are tools the Fed began adopting in the early 2000s. Um, I totally agree with this. Totally agree with this because I think there is a time to use forward guidance and there is a time to not use forward guidance. I think if you're in a moment of crisis, I think you need to use some form of forward guidance because you need to reassure the market that hey, we're on top of this. We're going to try to fix it. We're going to kind of try to get it straightened out. You need to try to calm markets down. So I think there is absolutely a time and place for it. However, should the Fed be using forward guidance all the time, like all day, every day? Should they be using it month in and month out, quarter in and quarter out, year in and year out? No, absolutely not. I do not think they should be using forward guidance in that nature. So, in that respect, I think Kevin Warsh is 100% right on this. The problem, again, that Kevin Warsh has is that a lot of these Fed governors, they love the microphone. They love being out on CNBC. They love doing their hits. Michelle Mickey Bowman just got in trouble, as we're going to see here in just a second. Michelle Mickey Bowman, she decided to do a private, event for Bank of America, and basically, which again, was it did she necessarily do anything wrong? No, not necessarily. But was it a good look? No, absolutely not. And it got back to the point of, what are you doing? You're basically there because Bank of America wants to get some kind of forward guidance. They want to get some kind of nugget there on what the Fed is going to do and how they're going to do it, so that they can play that in the market, if you will. And that's not a good look. Like, that's not a good look. And I think Kevin Warsh at some point is basically going to have to put, he's going to have to put all these Fed governors back in the box, and he's going to have to basically tell them like, hey, look, sorry guys, you're not doing any of these speaking engagements anymore. We got you have the blackout period, but now beyond the blackout period, I don't want to see you guys up on CNBC every month, doing this, doing that. But if he goes that route, he's undoubtedly going to face a lot of criticism over that. And some of the Fed governors undoubtedly will push back on that, i.e., Jerome Powell, perhaps. We'll see. But again, that's the forward guidance. Okay, now we get to balance sheets and interest rates. So Warsh conveyed to the House committee that interest rates remain the Fed's main policy tool. Still, any changes to the balance sheet would go through a thorough review process. As with forward guidance, the chairman has expressed the need to reform the balance sheet, which currently stands at 6.7 trillion, down from the post-pandemic peak of almost 9 trillion. If there were a change in balance sheet policy, we would preview it, explain it, debate it, and no changes in balance sheet policy would happen without good advance notice to the likes of this committee and broadly financial markets, he said. Ultimately, according to Warsh, the Fed should only use the balance sheet during a crisis. I'm going to say interest rates don't favor one class of people versus another. They don't favor those that have financial assets more than folks that are living off their bi-monthly paychecks, he said. So I like interest rates as the dominant way to make monetary policy, and I prefer, all things being equal, to use the balance sheet when the crises are real. So let's take a pause there for a second. Let me ask you a question. He's basically saying here, if there, what did he say here? He said, they don't, I'm going to say that interest rates, but no, he said, ultimately, according to Warsh, the Fed should only use the balance sheet during a crisis. What does that mean? That is bailout. That is bailout. If the Fed is using their balance sheet in a crisis, if they're expanding the balance sheet, that means they're pumping liquidity into the market. That is a bailout. That's quantitative easing. That's a bailout. Okay. He just said that he's like, oh, I'm not giving any bailouts. And this is exactly what I was saying right here a minute ago on the bailout topic. I said, yeah, this is all sounds good now. We'll see when the test comes, and what he just told you right here. What he just told you right here. The Fed should only use the balance sheet during a crisis. What he just signaled to you was that when a crisis comes, you're still getting a bailout. Okay, I'm still going to use the Fed balance sheet to bail you out in a crisis. Um, again, I'm seeing a lot of double talk here, a lot of double talk, and then we get into the ridiculous conversation of the Fed independence. So scores of Democratic lawmakers pressed Warsh on Fed independence, questioning if he will push back on possible interference by President Donald Trump. Warsh reiterated the necessity of the Fed being free of politics. Free of politics. Okay. All right. And if you believe that one for a minute, I got some land in Florida I'd like you to buy. Pledging to follow the law and the data. The law and the data. Okay. We're interested in what's happening in the war. We're interested in what's happening in military conflicts around, Warsh told Rep. Gregory Meeks. We have to take that all in, but then we have to shut the door and make our very best decision. Oh, isn't that wonderful? Isn't that so nice? Um, I said this before when Warsh got the job. Warsh has he has got I'm hoping he's up to the task here, because this is not going to be easy. This is not going to be easy. He has a monumental task in front of him, and he's not going to do it by trying to play both sides of the fence. He's not going to do it with a bunch of double talk. Okay, he's going to have to do it through making some very difficult decisions and with stern action. Stern action, meaning he's got to have a strong constitution to see some of these things through. This is not for the faint of heart. It is not. Absolutely not. All right, so then we get to Warsh's first big call, whether to undo last year's cuts. A steadier economy and stubborn inflation have put a rate increase in play. The new chairman who testifies this week hasn't tipped his hand. So yes, so basically the question being, some of the other central banks around the world, they increased interest rates over the last month. Would the Federal Reserve, follow suit? Basically, the sentiment has shifted from a rate decrease to a rate increase. But will they actually do that? I have said that no, they shouldn't do that, because what is driving up inflation has mainly been energy prices, and energy prices have been going up because of a shock to the system, if you will, with the Iran conflict. If that conflict goes away, those prices will then come back and return to normal. And raising interest rates is not really going to do anything, or not really do much to combat that. As history has shown us, when you have what are called supply side shocks, when you have a supply side shock, the raising of the interest rates, not really going to do too much to help in that situation. So I think the best thing they could do is to just pause and sit still at the moment. But we'll see. Now we go on to this. Our favorite, Senator Elizabeth Warren, our favorite. She spars with Warsh over Michelle Mickey Bowman's appearance at a private dinner. So Fed Chairman Kevin Warsh said he supports an inspector general's investigation of Fed Governor Michelle Mickey Bowman reported appearance at a private dinner hosted by Bank of America during a Fed blackout period. So it's really bad, because not only did she do this, but she did it during a Fed blackout period when you're not supposed to be talking. I really don't. I really love, or I should say love. I really like Mickey Bowman. I really like her. I mean, she has been fantastic. She's really supportive of community banks. I think she's one of the few good apples there on the FOMC, and I think she really is a good, genuine person. Why she did this, I have no idea. I really think that this was just a stupid move on her part, and she really should not have done this. But let's see here for a second. So, Federal Reserve Chairman Kevin Warsh on Wednesday avoided saying whether he'd ask Fed Governor Michelle Mickey Bowman about a bank hosted private meeting she reportedly attended during the Fed's blackout period, but said he supported the Inspector General's investigation of her conduct. Out of an enormous respect for the Inspector General of the Fed, his investigation, what he chooses to do with it, I'm going to leave to him to do without trying to micromanage that, Warsh told Senator Elizabeth Warren during an exchange amid a Senate Banking Committee hearing. And I'd be interested in the judgments that he comes to. Wednesday was Warsh's first appearance before the Senate committee. His second day of testimony on Capitol Hill. Warren also grilled Warsh on his sale of 100 million worth of shares in private investment vehicles just before becoming Fed chair, wondering whether someone paid him that amount, which he denied, which again, that was ridiculous. Um, but so getting back to Mickey Bowman for a second here. So the Fed's vice chair for supervision spoke at a private dinner hosted by Bank of America during the FOMC's blackout period, the Wall Street Journal reported June 19th. She reportedly spoke about monetary and regulatory policy, despite prohibitions on central bank officials speaking on such topics around Fed meetings. On July 1st, Warren, the committee's ranking member, along with Senators Jack Reed and Chris Van Hollen, wrote to Michael Horowitz, the Fed Board's Inspector General, requesting an investigation into the issue. Bowman has said she didn't share her views on monetary policy at the dinner, although public reporting indicates she spoke on a range of Fed monetary policy topics, including her views about the Fed's standing repo facility, the senator wrote. They asked Horowitz to review whether Bowman's actions violated Fed restrictions on external communications during blackout periods or other rules or policies. On Wednesday, Warren noted her request of the Inspector General, but you are the guy in charge, she told Warsh. She repeatedly pressed Warsh on whether he had asked Bowman about the dinner. As chair, you set the tone on culture, Warren told Warsh, who said he agreed with that sentiment. Warsh said he wasn't at the dinner and it would be inappropriate for him to prejudge facts. While the Inspector General's investigation is underway, I'd be very interested in the fact finding being done by an independent Inspector General, he told Warren. So, again, yeah, I mean, again, Michelle Mickey Bowman, she has been great. Um, I don't know where this goes because normally I would say that something like this would probably end up with a slap on the list from a slap on the wrist from the Fed Inspector General. But given the politics of the moment, given just the vitriol, if you will, between the parties, yeah, I don't know if this will result in just a slap on the wrist. Is this enough? Let's look at it a different view. Is this enough to get her thrown off of the Fed board or is thrown out as a Fed governor? I don't think so. If Lisa Cook can basically commit mortgage fraud and she can't get kicked off, then I don't think Michelle Mickey Bowman is getting kicked off because she went to a black tie dinner and said spoke some stuff when she wasn't supposed to. So, but we'll see. We'll see what happens on that. So now, let me make this a little bit. Let me make this a little bit bigger here so everybody can see this. So analysis. So Fed Chairman Warsh faces an inflation credibility test after congressional hearing. So Fed Chairman Kevin Warsh took 2 days of House and Senate questioning and made a few major missteps. Lawmakers in both parties agreed prices are still rising too fast, putting pressure on Warsh to deliver on his commitment to price stability. Warsh is questioning traditional inflation gauges, including CPI and PPI, while launching reviews of how the Fed measures prices. If inflation doesn't ease substantially, Warsh risks losing support inside the Fed and on Capitol Hill. Maybe. Let's see here. And then let's go to Kevin Hassett. Sees no excuse to raise rates, says Warsh will push Fed to the right answer. So National Economic Council Director Kevin Hassett said he sees no argument for raising interest rates in light of the latest data on the U.S. economy. Fed Chair Kevin Warsh, President Donald Trump's pick to succeed Jerome Powell, is going to drive the committee to the right answer. Hassett called the latest consumer price index reading one of the best inflation reports that I've seen in my entire career. Now, there's a little hyperbole there for sure, but I think what Kevin Hassett is saying at the moment is right. I don't think that there is a need, at least right this second, for Kevin Warsh to increase interest rates. So that's kind of his opinion coming in there. And now and now why did he say that? Why was Kevin Hassett was talking about? So this is what he was talking about: the consumer price index, the CPI. So basically what we have here is consumer prices rose 3.5% annually in June, less than expected as energy prices eased. So the consumer price index, the CPI, fell a seasonally adjusted 0.4% for the month, bringing the annual inflation rate down to 3.5%. Wall Street had expected a 0.2% monthly decline and 3.8% annual level. The monthly drop was the largest since April of 2020. Core inflation, which excludes food and energy, was flat on the month, putting the 12-month rate at 2.6%. The consensus forecast for the respective increase of 0.2% and 2.9%. The easing of prices came from a big decline in energy and an easing in services costs, particularly for housing. And yes, and now we're going to go to our next here, where we're going to go. Let's look at the numbers from the chart here. So all items, again, 3.5% inflation for the month of June. But we see the big culprits here. Again, energy at the big culprits, 15.7%. Gasoline up, 26.7%. Electricity, 4%. Piped gas services, 3%. Airline airfares up 26.5%. Why is that? Well, purely because of gasoline. Gasoline goes up, cost of airfare tickets is going to go up. And the airlines, they are happy to gouge us. They are happy to gouge us all day, every day, and they will wait until the bitter end to bring those prices back down. Yes, they will. Most assuredly will. But then we look at some of the other, motor vehicle maintenance and repairs is running at 7%. And then tobacco and smoking products is at 6.5%. Those are the other kind of couple of big culprits there. But let's take a look at food at home and everything. I mean, everything is up very steadily. The one troubling one here is probably fruit and vegetables is up 5.3%. That's not good. But then we have, just food at home up 2.7%, cereal and bakery products up 2.4%, meats, poultry, fish, and eggs up 2.6%. Dairy is up just a small 0.4%. Non-alcoholic beverages and materials up 2.9%, and then other food at home 2.4%, and then food away from home, in other words, eating out, up 3.4%. So again, inflation still staying high, but you could see again, if they could just get out of Iran, just get out of that thing. All these prices would, as particularly energy prices, would come way back down, and we would find a much easier way of controlling this inflation and getting it back under wraps. And I'm going to share some articles with you guys here in a few minutes that we're going to be looking at kind of the hardship on the American people at the moment, if you will, and what this increase over the last 4 or 5 months in inflation, what is that? And that is finally starting to really have an effect on consumers. And we're going to take a look at that in a few minutes when we get to that series of articles I have for that. Now, on the other side of this, we have the CPI, but then we also have the PPI, which is the wholesale. Wholesale prices unexpectedly declined 0.3% in June on a big drop in gasoline. So the producer price index, a measure of wholesale costs, fell 0.3% in June against a forecast for the gauge to be unchanged. The core PPI rose 0.2%, slightly less than expected, while core less trade services increased just 0.1%. This was the second straight day for positive inflation reports, with consumer prices off an unexpectedly strong 0.4%. The moves were largely driven by fallen energy prices. So yes, so that is good. Now, I pose a question to you. I ask this: will this trend continue? Like I've always said, 1 month does not a trend make. Okay, in economics, when you're studying economic indicators, you have to look at the trend, and you have to look at, it takes multiple months, usually 3, 4, 5 months, maybe even sometimes even 6 months to a year for that trend to really begin to surface, for you to get a real idea of what the market is really doing. So will this trend of declining inflation, will this continue? I would say not at the moment. Again, when you go back to this, when you go back to the what I showed you guys at the beginning with the crude Brent, the crude oil futures, the Brent oil futures. Again, this has the ability now with these attacks on Iran and with the attacks escalating, with there being a lot more bombing, not only in Iran but in other parts of the Middle East. There, it is undoubtedly these numbers are going to go. These could go right back up to the $100+ about $100+ a barrel that we just saw, we were just witnessing, 3-4 weeks ago, and we could go right back there very quickly. So, and again, right now, right this minute, it does not look like this Iran conflict is going to end in the next couple of days or the next week. I mean, this looks like this is going to go forward at least for a few more weeks. And if that being said, these numbers are going to continue, which means that when we get the inflation numbers for July, those numbers are going to be right back up, which is very, disappointing. But it is what it is. What are we going to do? All right, now the next thing I want to show everybody was just the job numbers. So this came out a couple weeks ago, but the U.S. snaps hiring hot streak with only 57,000 jobs added in June. The unemployment rate edged down to 4.2% as more people left the labor force. That means the workforce labor participation rate declined, artificially keeping that unemployment number down. But again, looking at the jobs here, we on the good side, this was the fourth straight month of positive job numbers, and it was the fifth time in the last 6 months that jobs have been positive and been up, that is a good thing. That is a good trend that we are seeing. But it was a small number this month. It was not a huge, not a big number. The U.S. economy added fewer jobs than expected in June, cooling from a strong spurt this spring. American employers added 57,000 new jobs last month, the Labor Department said Thursday, missing economists' expectations for a gain of around 115,000 jobs. That prompted investors to dial back their expectations for interest rate increases by the Federal Reserve this summer. Still, the job market appears to be on firmer footing than it was in the second part of last year. The economy added on average 92,000 jobs a month over the first half of this year. In the final 6 months of last year, it actually shed 8,000 jobs each month on average. Now we get into a smaller workforce. The unemployment rate ticked down unexpectedly to 4.2% as more people left the labor force. The share of the working age population that is either working or looking for work, known as the labor force participation rate, edged down to 61.5% in June, the lowest since March of 2021. And basically, we have here the unemployment rate right here, and and they talk about revisions. So Thursday's report showed job growth in May and April was weaker than previously thought. Employment in April and May combined was 74,000 lower than earlier reports. So let's see here, and then we get into a little bit about wages. We're not going to get into all that, but I just wanted to show people that what was happening with the labor market for the moment. Now, couple of other related articles on this. So this year's job market is shaping up to be surprisingly stable. So June data was underwhelming, but today's job market is much less concerning than it was 6 months ago. So halfway through the year, the labor market is flashing a virtue that proved elusive for much of 2025: stability. American hiring in 2026 hasn't quite boomed, but it has broadly improved. So again, like we said there, 6-month moving average change in non-farm payroll. You can see here over the last 6 months, we are heading up, while the monthly change is heading on a downward trend there. But again, not terrible, not terrible. And so this again is part of why Kevin Warsh doesn't really have to increase interest rates at the moment. The labor market is holding firm. Labor market's holding fine. And like I said, it's not on fire. It's not the greatest labor market ever, but it's not doing too bad either. So again, so that's a good thing. That's going to help him because now, if you could take the labor market out of the equation for the moment, now you're just focusing on inflation. Now inflation's the big thing, and you got to work on that. Problem is, the president is not helping very much with the Iran conflict. That is not helping our cause. That's going to make it very difficult for Mr. Warsh to really have an impact or really do much on the inflation front in the short term. So but like I said, so I wanted to share that, but then I also wanted to share this. So this is a little bit part of our AI conversation, but this also really plays into with the labor market. So big tech has suddenly flipped on the AI jobs wipeout scenario. So as public opinion of AI shifts into the negative, warnings of mass employment reductions have diminished. So a year ago, the message from many business leaders was that AI was going to wipe out jobs. For the past month or so, tech CEOs have been striking a more optimistic tone. In late May, OpenAI chief executive Sam Altman, who has long predicted that AI will lead to seismic shifts in the workforce, said during a conference, "We've been roughly right on technological predictions and pretty wrong on the social and economic implications." Soon after, he told CNBC, "Our industry overestimated how much we're going to be able to keep people at the center of everything." Anthropic CEO Dario Amodei, who warned in May of 2025 that artificial intelligence could eliminate half of entry-level jobs a year later, highlighted more positive scenarios for AI adopting businesses. They could do the same thing with less resources, and that leads to things like layoffs, or they could do more with the same amount of resources, but that requires creativity. In a June essay, the executive wrote that in giving warnings of job displacement, he wanted policymakers and the private sector to have the best chance at adapting. He wasn't trying to be a prophet of doom. He also wrote that the possibility of enduring job losses remains. In the sunnier outlook, a move to win back customers and the public who are souring on AI's world-ending promise, or is the role of AI in the workplace now just better understood? So, there are a couple of things going on here that you have to understand. Number one, I think first and foremost is the PR. I think they went out, they've been telling everybody, they've been promising all of big corporate America that AI was going to answer all their problems. AI, they were going to be able to put AI to work and eliminate all these jobs, become massively more efficient. The AI was going to drive all their revenue, yada, yada, yada. Now, what people are finding out with AI, these big companies are finding out that they're spending millions, for some companies, tens of millions, even hundreds of millions of dollars of AI. And AI has delivered a little bit, but hasn't really delivered on any of these major promises. They haven't. What companies are actually finding out now is that they prematurely laid people off, and now they're realizing that they're going to have to go and hire a lot of those people back. Because the AI just either they ran out of money spending on these AI tokens, they blew through their AI budget, and now they're like, oh man, we're stuck. We're the AI. We spent all this money on AI and we laid all these people off, but then the AI didn't come through. We're out of money. We blew we blew our token budget. So now now we're gonna have to go back. We're gonna have to hire those people back to get everything moving again. So this whole AI dream has kind of blown up in their face a little bit at the moment. Um, so those two different things are going on there. You have the reality of what's happening versus the PR of this whole thing. And they know that the AI thing. First of all, just take a step back for a minute and think about something for a second. Okay, why in the world? Okay, even if you thought that AI was going to take everybody's job, okay, even if you're one of these guys and that's what you think, why would you go out and make that your primary sales pitch? Like, why would that be the thing that you lead with? It just boggles the mind. It makes no sense. Like, why would you run out and be Captain Gloom and Doom and just on CNBC and in the Wall Street Journal and the Financial Times and all this stuff? Why would you be out there just all day, every day? Oh yeah, this AI product is going to take everybody's job. It's going to, yeah, nobody's going to work and blah blah blah. Like, it's just sooner or later, you had to realize that sooner or later, people were going to look at that and be very turned off by that message and say, like, yeah, I don't want to lose my job to AI. I don't want AI to replace me. I don't want these massive AI data centers in my backyard. I don't want any of this. Um, I don't want the flock cameras all over my neighborhood. That argument, I'm not getting into that. I'm not touching that hot potato, but I'm just saying that that conversation is going to get real wicked in the next year. You wait. That people, you're going to start to see massive blowback on the flock cameras because what are we doing with the flock cameras? Are we seriously? We're basically turning ourselves into China. That's exactly what we're doing. If flock cameras get put up all over the United States and every on every corner in every town, we became China. Okay, our government became the CCP. Man, we did that's what happened. The totalitarian nanny state it will be in full work. So, but anyway, like I said, I'm not getting on my soapbox about that. I'm not going down there. Like I said, I just wanted to show this because I think that this is actually a good thing for the job market because this means that there has to be this recalibration around AI, and we know that, like, okay, everybody's not going to lose their job to AI tomorrow, right? So that's a good thing. So that's going to help to keep the economy, at least, throughout the rest of this year, possibly going into early next year, is going to keep the job market on stable footing, and that's a good thing, and that's why I wanted to show this. This will play in to some of the conversation on an AI a little bit later, but like I said, I'm gonna end it with that for the moment. So, all right, let me see what else here before we have to the. We'll get into the quarterly earnings when we come back. I'm gonna finish this real quick for a moment. So I had been saying this for a while. I have felt like some of these surveys on consumer sentiment were really messed up. And what do we have here? We have this article. Do we really feel this lousy about the economy, or is a key survey broken? The University of Michigan is pushing back and defending its widely tracked consumer sentiment gauge. So, a key survey of American consumers is scraping bottom, showing that we've never felt this lousy about the economy, even at the height of recessions or even the COVID pandemic raged. Is the survey itself the problem? That is the question I have been asking for over a year now. That's what a growing number of critics, including several economists, are saying. They've pointed to methodology changes in the University of Michigan's Consumer Sentiment Index as bugs in the machine, saying they are skewing the results. On Friday, Michigan's survey of consumers, which has been polling U.S. households since the 1940s, pushed back, saying the survey is sound. Instead, low sentiment likely reflects a profound shift in mood since COVID struck, according to survey director Josanne Hughes. It shouldn't be too surprising that people felt differently about the world, including the economy, after the pandemic. The sentiment index hit 44.8 in May, marking its lowest level on record. On record, really? And I just ask it a common sense question. Do we really feel like that sentiment would be at its lowest level ever? Ever? I'm sorry. I have lived in my just corporate life. I have lived through the dot-com bubble. I lived through the Great Recession, the bursting of the real estate bubble. I lived through the pandemic. I can assure you that sentiment has been way, way lower than it is right this moment. So how in the world could this sentiment index be at the lowest level on record? And in June, it ticked up only marginally higher to 94.5. That's still under the prior record low hit in mid 2020 when inflation soared above 9%. So the low readings seem at odds with an economy that appears decent, if not stellar. The country is adding jobs and consumers are continuing to spend despite worries about inflation and affordability. Critics think there's more to the story than Americans feeling particularly morose. Instead, they say shifts in how the survey is conducted are clouding the picture. Yes, I would say that absolutely. I would even be willing to say that there's probably, wait for it, some politics at play here. I would be willing to say that up there in Michigan, those lovely people that are running this survey may be playing just a tad bit of politics and how they're getting at and developing their numbers. Maybe they don't want there to be a positive sentiment at the moment. I don't know. Maybe because they don't like the guy in the White House. Maybe, just maybe, just a thought, just maybe. But this, I love this because this article finally brought to light what I have been saying for over a year now, that I think that there is something really wrong with this consumer sentiment gauge. I think it's being manipulated. I think they're doing it on purpose. I called out this same nonsense when the Bureau of Labor Statistics during the entire Biden administration was putting out these ridiculous, absolutely ridiculous job numbers that you could tell were false. They were absolutely false. I said that for 4 years during the Biden administration. I was adamant that these job numbers are ridiculous, and sure enough, the truth came out that that's exactly what was happening. And the Bureau of Labor Statistics was over there cooking the books for years. And I think so. I think the same thing is happening now with this, with the University of Michigan consumer sentiment gauge. I think they're doing the same nonsense over there, and I think it's, and again, I think it's all politically motivated. Unfortunately, for all of us, I think it's politically motivated. So, but anyway, all right. That being said, let me shift gears here for a moment. It is that time in the show where I like to give you guys, I like to get into the economic indicators that are coming out this week. I want to give you guys some banking news, and then I also want to go over the episodes that I've had out on the podcast. It's been an interesting couple of weeks because for the first time ever, for the first time in almost 3 years here, I'm trying to think here. I will be celebrating the 2-year anniversary of the live stream, the strategy room here in next month in August. And I will be celebrating the 3rd anniversary of the launch of the podcast, because I did the podcast for a year before I did the podcast for a year before I started the live stream. So it'll be the 3-year anniversary of the podcast and the 2-year anniversary of the live stream coming up next month in August. So, but with that being said, let me go to, I have up here on the screen so everybody can see it. What are our economic indicators coming up this week? So on Monday, July 20th, we get the U.S. leading index for June. On Tuesday, July 21st, we get the ADP employment change weekly. We get the API weekly crude oil stock. And on Wednesday, July 22nd, we get the 20-year bond auction. On Thursday, July 23rd, we get initial jobless claims, continuing jobless claims, the 10-year TIPS auction. And then finally, on Friday, July 24th, we get the building permits for June, manufacturing PMI for July, services PMI for July, new home sales for June, and the U.S. Baker Hughes oil rig count coming out 1 p.m. on Friday. So that is your economic indicators for the week. Got a lot of good economic information coming out. Can't wait to see all of that. So now I will switch gears and talk about some of the episodes that I had out. So we're going to go back to 3 weeks ago. I know we're going to go back in the time machine way back. All right. And I'm going to go through this rather quickly this week because again, I did a lot of best of, but let's do this. So on the week of June 29th through July 3rd, I put out 5 episodes that week. The first episode that week was an interview with Dr. Bill Minnis. Now, Dr. Bill Minnis is a friend of the channel. Bill has been on. I did a previous interview with Bill. Bill is a very fascinating character. He's a very interesting individual because he has had his foot. He's had his foot in the banking world and in the world of academia for many years. He's been the dean of multiple universities. He's also been a bank CEO. I think he served on other bank boards and things in the past. So he has been very active in both industries. So he has a very unique insight as to just how things are going between the two worlds, if you will. So we got into a lot of what is AI doing, how is AI changing the landscape, what's happening in academia right now, and how does that ultimately tie into the banking industry in terms of how does efficiency come into the equation, and what is this ultimately doing for the future of banking, if you will. So again, really good conversation there with Dr. Bill Minnis. I hope everyone will check that out. Then on Tuesday, I did another banking news episode. That was June 30th. So just all the typical banking news in that. On July 1st, I did what I thought was a very interesting episode called "It Turns Out AI is Just Human After All." Now, what I did was I covered this article that talked about this AI test that was basically not very many people knew about this test, but it was an AI test that was conducted using the largest four AI models. The test included Gemini, ChatGPT, Grok, and Claude. Researchers built a virtual town with a town hall, a marketplace, police station, and homes. 10 AI residents with jobs, names, memories, and relationships were created. The town was provided with an economy. Residents were expected to earn their keep, follow rules, carry out tasks, and create laws. Crimes had to be identified. AI residents were not supposed to commit crimes. Once everything was ready, the researchers stepped back and they let the AI run the virtual town for 15 days. The researchers ran 5 versions of the test, all with the same rules. Each AI system received one test, and then one test was commingled with all 4 systems. Now, the results of this test were a complete and utter disaster. Grok failed in 4 days. Everyone died. Everyone died. Gemini failed while committing 700 crimes, and the residents burned down the town. ChatGPT residents stopped doing what was required to live, and they all died. Claude actually made it through the 15 days, but had an abnormally high level of agreement, which the researchers agreed was wrong. Something was very wrong with the AI there. The final mix test showed that safety is not a static model property, but an ecosystem property. This test is a warning of the danger that AI poses. AI is created by humans and thus subject to human flaws. So again, I thought that was a great episode. I thought it was really interesting talking about this very fascinating AI test that happened. And I hope people will go and check that out. Then I had a couple of research related episodes. I did what did the Fed discover from their focus group on unbanked and underbanked demographics. I covered a blog post from PCBB there on that basically covered some research that was done by the Cleveland Federal Reserve Bank. Then on that Friday, July 3rd, I did checking up on CECL, which is the current expected credit loss model for banks. Now, again, so if you want to go check that out, I just tried to give an update on CECL and what was going on there, how that was working with loan loss reserves, loan loss provisions, ALCO, so on and so forth. So go check that out. And then on July 4th, I put out the BND July 4th special celebrating America 250. I've said this July 4th, we celebrate America's 250th birthday by considering Adam Smith's views of free trade. What did he get right and what might he have gotten wrong? We also consider 10 enduring lessons from Adam Smith. In addition, what American classics should you be reading this 4th of July? So again, I thought it was a pretty decent July 4th episode if you want to go check it out. Actually, last year's July 4th special, I did kind of a book review on Adam Smith's enduring classic, The Wealth of Nations. So if you can almost look at those as 2 bookends. So if you want to go check the 2 of them out. Then the last 2 weeks, I actually did for the first time ever in the 3 years of doing the podcast, I did a best of for 2 weeks. And I decided to make the first week, which was July 6th through the 10th, I decided to make that the best of the Lords of Easy Money. And so what I did was I did Lords of Easy Money part 1, 2, and 3. Monday, Tuesday, Wednesday, and then on Thursday, I did the best of BND, the Lords of Easy Money, looking forward, which was kind of a look forward after the book, kind of saying, okay, the book ends in 2021. Where do we go from there to today? And then on Friday, I did the best of BND, the Lords of Easy Money. I capped the week off with the interview that I did with Dr. Thomas Honig, who was the main character of the book. He was the dissenter, if you will, the one sane voice in the Federal Reserve back then in 2009, 2010, who basically said, no, I'm not going along with this. I don't think that the quantitative easing is the way to go. I think you're winding up things that are going to be very difficult to unwind. And he was 100% correct. But again, great interview there with Dr. Thomas Honig. I had a great time doing that with him. Hope he'll come back and join me again someday. But I will just mention this, and again, and I did this because I wanted, people who were maybe new to the channel, who because I did that Lords of Easy Money series. I did that pretty early on, like the first year and a half that the podcast was up. That's really where I did that Lords of Easy Money series, and there's like 21 total episodes in that series. But the way that I did it was that there are like 16 chapters in the book. I do an episode review, literally reviewing the whole chapter in each book, talking about different aspects of each chapter. But then I also did basically just sections. So there's three sections to the book. So I did episodes where I covered each of the three sections in one episode, and those were the episodes that I put out as part one, part two, and part three, so that basically people could go in and they could just get, like, I just covered each of the three sections of the basically of the book, covering the whole book, but just doing it in three episodes instead of 16. So I designed the series so that, depending on what you want to do, like if you wanted to do the deep dive and you wanted to go through if you wanted to go through every single chapter of the book, that's all there. If you just wanted an overview of the sections, that's all there. I have a kind of if you just wanted to go to the last episode and just look at my kind of conclusion, overall review and an overview of the book, you can just go watch that one episode. So I designed it. I designed that whole series to give people multiple ways to dive down into it. If you want, like I said, if you wanted the quick overview, there was just a conclusion episode. If you wanted to go through the whole thing, or if you wanted to break it down just watch the three episodes on covering the different sections, you could do that. So that's how I basically put that series together and put it out there. But like I said, I wanted to give, obviously, a lot more listeners now than I had when I started 3 years ago. So again, I figured a lot of the newer listeners who have just come on within the last year or so, they probably hadn't had a chance yet to see any of that, go back and watch any of those Lords of Easy Money episodes. So that's why I wanted to focus on that and put that out there, for people to check out. So, and then this week, July 13th through the 17th, I basically put out 5 episodes. I did another best of week, but I did best of interviews. So I wanted to go back and I put out 5 interviews that I thought were really good that I've done over the last 3 years. I started out, the first 2 interviews I did with Bob Newman, from Chatham Financial. And I did 2 interviews with Bob, and the one was basically just an introduction to Chatham Financial, like what they do. Really cool company. Really, they deal with basically a lot of hedging strategies for banks. They deal with derivatives. So it's a very, very interesting, sophisticated company. And then the second part was that Bob and I actually go through just a standard vanilla derivatives contract, and we talk about how a bank would use that vanilla derivatives contract as a hedging strategy on their balance sheet. So again, a very popular episodes. People really like these episodes back to back, so I wanted to put them back out there. Then on Wednesday, I did interview with Greg Smith, who is the curriculum director at the Stonier Graduate School of Banking. On Thursday, I did the interview that I did with White Clay, the founder and president of White Clay, Mac Thompson. Mac, another great individual. White Clay is a consulting firm that does a lot of work with hundreds of banks all over the country. So they do a lot of great things. And then finally, on Friday, I did best of interview with Alan Berkeley, where we covered what I called the chaos in Kansas. So Alan and I had a conversation of the failure of Heartland Tri-State Bank in Kansas. And basically, that I thought was a great conversation, because Alan's a friend of the channel. I've done a number of different interviews and kind of discussion topics with Alan over the years. And I really wanted to dive down and just talk about, like, how, when a CEO does really bad things, and it causes a chain reaction throughout not just the bank but through an entire community. And that's really what I wanted to highlight. I mean, Heartland Tri-State Bank was not a big bank, but it was basically the only bank in that Kansas community. So when they failed, a lot of community members were on the board of that bank. They were just, regular people, farmers, people that own local businesses from around the area. I mean, so that has a massive ripple effect on the town, and it does. When you destroy the public trust like that, as this CEO in this particular instance was a gentleman named Shane Haynes. When you do that, it has a dramatic domino effect on an entire community. It's not just the bank that fails. It causes ripple effects through, it just hurts businesses and individuals and ruins lives and careers. And it can get really ugly. And I wanted to show that aspect of it, not necessarily the nuts and bolts or talking about the fraud or the rationale for it. I wanted to show basically the collateral damage that gets caused by bad actors that are in prominent positions at banks. And it's when it does happen, it's pretty bad. So like I said, so I just wanted to highlight that, and I thought that Alan and I had a great conversation. Right, it's a little bit of a longer episode. I think that one goes for about 40 or 50 minutes, but I loved it, and I let that roll, but just because I thought it was such a great conversation on such a very important topic in the world of finance, in the world of banking, if you will. So, all right. Those were the episodes for the last 3 weeks, and I'm very happy to announce this week coming up. Again, I'll be back to all new episodes. I really would like to hear people's thoughts, though. If people liked the best of series, I mean, again, not that I'm going to be doing that all the time, but I would, if people like that, I will certainly run more of that in, like, every year when I take a vacation week here and there. Really will probably run more of the best of BND series, just to give people a chance to look at different episodes, stuff like that. So so again, if people like that, let me know. So put in the comments, let me know what your thoughts are on all of that. So okay, let's get into some banking news here for a few minutes, shall we? So let's look at some economic indicator news. So business inventories grew in May. Pending home sales dropped in June. Retail sales increased in June. Builder confidence dips in July. Mortgage applications decreased. Obviously, with the increase in interest rates, you can understand why. Producer prices dipped in June. We talked about that. Economic activity increases in recent weeks, according to the Beige Book. So economic activity increased at a slight to modest pace in 11 to 12 Federal Reserve districts in early June through mid-July, according to the latest Beige Book of Regional Economic Conditions. According to the KC Fed, farm lending dipped in the second quarter. The CDFI warns of fraud attempts, so we'll keep an eye on that one. Let's see here. Small business optimism rises in June. Consumer prices fall in June. We talked about that. Survey community bankers remain optimistic. So community bankers nationwide remain broadly optimistic about future economic conditions, according to the Conference of State Bank Supervisors' latest quarterly poll. The regulators closed Indiana Bank, the third bank failure of 2026. Hint, hint. There might be an episode covering that coming up this week. Just a hint there. But the OCC closed Kentland Federal Savings and Loan Association of Kentland, Indiana, and the FDIC entered into a purchase and assumption agreement with Kentland Bank of Kentland, Indiana, but there was no affiliation between those two. So yeah, and my understanding is that bank had a lot of issues and was under all, like, a memorandum of understanding, other things. So yeah, I'm sure I'll have more of a story of that this week. Fed to Congress. All tools will be used to achieve employment price stability goals. Yes, we talked about that a little earlier. OCC revises their credit losses handbook. Community Bank Research Conference announces papers selected for presentation. So I might look at a couple of those down the road, depending on what they are. White House announces an AI clearinghouse. This is very interesting. The White House this week announced the creation of Gold Eagle, an initiative to enable artificial intelligence innovation by creating a clearinghouse for cybersecurity vulnerability conditions. I like the sound of that. That hopefully they'll rein in some of these frontier models a little bit, but we'll see. But I think that's a good step. Housing bill with community bank regulatory relief becomes law. We talked about that at the very beginning. The 21st Century Road to Housing Act, which got passed and went through. SBA raises combined loan limit and enhances lender tools. So the Small Business Administration announced that it has officially raised the amount that qualified borrowers can access through its 7A and 504 loan programs and has enhanced its online tools for lenders. New ICBA supported bill would strengthen SBA 7A lending. A bill to promote transparency in the Small Business Administration's 7A loan guarantee program was introduced into the House of Representatives. So we will keep an eye on that one, certainly. A new article says that ICBA's efforts may be slowing credit union acquisitions. So, a new article says credit union acquisitions of community banks have slowed this year, possibly due to increased public scrutiny fueled by ICBA's efforts to raise awareness of the issue. I don't know about all that. I think that might just be good old fashioned numbers. The fact that other banks are anxious to buy and merge, and they're putting good competitive numbers out there as far as what they're offering in terms of sale prices and things like that. So I think that's more at play than credit unions not wanting to buy. But anyway, Fed's Michelle Bicky Bowman says regulation must be modernized. Federal Reserve Vice Chair of Supervision Michelle Bowman said the financial system is constantly evolving and the regulatory and supervisory framework must keep pace. Yes, of course. Agencies issue guidance on banking with unauthorized workers. So, federal financial services regulators issued guidance to banks on credit risk management as it relates to borrowers who are not legally authorized to work in the United States. Ooh, very interesting. In accordance with President Donald Trump's May 19th Restoring Integrity to America's Financial System executive order, the OCC, FDIC, and the National Credit Administration said lending to individuals who are not legally authorized to work in the United States may present elevated credit risk because a borrower's ability to generate income, maintain employment, and maintain financially stable may be subject to greater uncertainty. Yes, in other words, they get evicted, they're gone. How are they going to pay your loans? Financial institutions should identify, measure, monitor, and control these risks through safe and sound underwriting practices that assess a borrower's willingness and capacity to repay according to the terms of the credit obligation. Yes, so very interesting. So it appears that where the administration is going is kind of what I had said months ago, and that is if you really wanted to deport people, you don't need ICE. You don't need ICE to do that. What you need to do is you need to shut them out of the financial system. If you shut them out of the financial system, they will leave on their own. They will self-select out because they will not be able to live a normal life. They will not be able to make money. They will not be able to get a job. They will not be able to pay bills. They will not be able to get on public assistance because they're not legal citizens. So therefore, if all the freebies are gone, if they can't work, if they can't get money, if they can't send the money back to whatever country they came from, if they can't do all that, then they will self-select. They will leave voluntarily. You won't need a single ICE agent to do any of that. They will go themselves. So it seems like the administration is probably waking up to that and saying, you know what, this is probably the better path to go down. We'll see though. We'll see. ICBA urges grassroots actions on Fed payment account proposal. ICBA is urging community bankers to contact the Federal Reserve regarding its proposal to create a payment account, also known as a skinny master account, for institutions outside the traditional banking system. Yes, this has been a fight that's been going all year, so we'll keep an eye on that. ICBA urges administration to protect community banks, CDFIs during streamlining effort. Okay. AML Watchdog highlights virtual asset regulatory gaps. So the Financial Action Task Force said virtual asset enabled illicit activity has become more complex and interconnected. Okay, we'll keep an eye on that. The CFPB director, a new 1033 proposal is coming soon. The Consumer Financial Protection Bureau acting director Russell Vogt said the agency is close to finalizing its Section 1033 rule on sharing consumer financial data. This is something I've been dreading for a while. Section 1033, that is the open banking rule that the CFPB put through. I do not like open banking. Do not like open banking. Do not want open banking. I think it was ridiculous what they put out before, and they again, you could go back. I've done a number of episodes on open banking. I'm sure as this new rule comes out, we'll see what's in it. I'm sure I'll be doing more to cover that and what's going on with that as it comes out. And I'm sure I'll be going back to the discussion points of a lot of what I spent a whole year, all last year, talking about in all the negative aspects of open banking and why consumers don't want it, businesses shouldn't want it, banks shouldn't want it. It is just they're going to try to sell it to you as, oh, it'll be so much easier for you to move your information from one place to another. It's not. It's not. What it will do is it will allow everybody and their mother who wants to pay for it or not pay for it. Google, think of Google, Meta, all these companies that have been salivating for years to get their hands on your banking data. This is the door. Open banking is the door that will allow them to get it. This is why we do not want open banking. We don't want it. We don't want it to happen. And keep in mind, the 1033, it is not a law. It is not a law. It is a rule put forth by the CFPB. And again, I could get into a whole other conversation about the CFPB, but it appears that the Trump administration wanted to get rid of the CFPB. It pretty much appears at this point that is not going to happen. What remains of the CFPB after the Trump administration is done, we'll see. But something will remain of it. They're not going to get this thing gone. That's what's going to happen. But we'll keep an eye on this 1033 rule. Regulators to coordinate handling of highly sensitive information. I'm going to talk about that more in just a few minutes. ICBA supported bill to combat senior fraud is introduced in the House. House passes legislation to end penny production and allow rounding. The House of Representatives passed by voice vote legislation to stop penny production and allow rounding. So we'll keep an eye on that. But again, the penny continues to come to an end. Grassroots outreach is needed ahead of the House vote on regulation relief bill. So ahead of a likely House vote next week on the ICB advocated Main Street Capital Access Act, ICBA is calling on community bankers to urge the representatives to support the regulatory relief bill. So keep an eye on that one, see what happens there. A couple other things here. ICBA op-ed questions demand for crypto policies. ICBA urging grassroots as Senate works to bring Clarity Act to a vote. ICBA and others urge Senate to strengthen stablecoin yield provisions in the Clarity Act. So the Clarity Act, the battle continues. And then finally, ICBA and state associations push for thoughtful, coordinated Genius Act regulations. ICBA of 44 state banking associations expressed concern about the rushed pace of payment stablecoin rulemaking and urged federal banking regulators to coordinate closely on the final rules. So yes, so we will see as they begin to outline that with the Genius Act. We'll keep an eye on that and see how a lot of that plays out. Okay. Let me switch gears here for just a second. You know what I want to bring up? I want to bring up the summer reading list. So let me switch out of here for a second. And I'm going to go back in so that I can share this. Let's see here. That's not now. Maybe this. No. Hold on. I'm gonna get there. We're gonna here we go. Found it. Okay. All right. Here, hopefully everybody can see this. This is the summer reading list. Let me see if I can make that maybe a little bit bigger. There we go. How's that? Okay. So, all right, let me grab these books here. Let me put all these books up on here. All right. So, want to go through these very quickly. So this is my summer reading list, as I promised everybody that I was going to put up here. So first book on the list, Suicidal Empathy by Dr. Gad Saad. This was an absolutely phenomenal book. I'm going to do I'm working on a book review for this right now, but just Suicidal Empathy, brand new book just came out. I don't know, maybe about 2 months ago, but absolutely phenomenal book. Not a very long book, only like I think 165 pages, so you could get through it pretty quickly. But just a great book, and really hits home on a lot of the key topics and things that are going on in our society right now. Reshore. Absolutely love this book. I think I talked about this book. This book came out about a year ago. How tariffs will bring our jobs home, plus revive the American dream by Spencer Morris. This was a phenomenal book. I would love to see if he could do some kind of an update to this. Obviously, given what we've seen with the tariffs and how things have played out with the ruling from the Federal Reserve, tariff papers that we've seen from the Federal Reserve in that time period that came out. But again, just a very well written, very well articulated argument for how tariffs will help us rebuild our economy and rebuild the manufacturing base in America. And now, again, there's a lot of detractors to this. A lot of people, basically, there's economists and other people out there that basically just say, "Oh, this is a pipe dream. It can't happen. Whatever." I don't believe. I think if you read this book, you will be convinced. And again, I will do. I'm working on a book review for this as well. But if, again, I think if you read this book, you will be convinced by the end that yes, tariffs are the way to go, and they will cure. They're not a total cure, but they will cure a lot of ills in our society. The repo market. Shorts, shortages, and squeezes by Scott Sickram. This was from 2023. I have looked for a lot of books on the repo market and really had a hard time finding good book. This was one of the best books that a lot of the books I found were like academic, textbooks for classes, and one or two of them looked really good, but that wasn't necessarily what I was looking for. This book, if you want to learn about the repo market, you want to learn about the history of the repo market from the 1980s and 90s, when it was this sleepy little market, and then how it got blown up by the Fed, basically starting after 07, 08, and how they basically put the repo market at the start of at the core of liquidity for the liquidity funding mechanism, if you will, of the economy. The repo market is a great book. Also, at the end, he talks a lot about the repo market collapse in 2019. So some great things there. Then we get to Crisis and Leviathan. Now, this is an older book. It's the oldest book on the list. This is Critical Episodes in the Growth of American Government by Robert Higgs. I think this should be standard reading in every college, every business school. This should be standard reading. I learned about this book. This was a book that was written in 1987. Now, a lot of what he kind of covers the late 1800s all the way up through into the 1980s. So he covers about 100 years from, you could say, like 1880 to 1980, that 100-year period of time. But what he talks about there is like, why does every crisis get bigger and bigger? Thus, Crisis and Leviathan. Like, why does government continue to just constantly grow bigger and bigger? Why is there no breaks or stoppage on this? Why is every crisis that we have just it goes from millions to billions to then trillions of dollars? Why is this? Why does this happen? And he explains all this in great detail in this book. And you really begin, if you read this book, you will really get a really dynamic understanding of the government and how the government works, and why every time something happens, we have some major crisis or some blow up in the economy. Why does it keep kind of compounding itself decade after decade? Why does all that keep happening? That book explains it. And even though this book is literally approaching 40 years old, the lessons in it they're just as relevant today as the day that they wrote the book. So again, fantastic book there. And then I had three new books: The Banker Who Made America, Thomas Willing and the Rise of the American Financial Aristocracy by Richard Vague. I did an interview with Richard Vague about this book, if anybody wants to go check that episode out, but just a phenomenal book by Richard Vague there on Thomas Willing. If you like that kind of revolutionary time period, the founding of America, the creation of our financial system, the banker who made America, Thomas Willing was Robert Morris's partner, and it was basically the two of them that together that financed the American Revolution. And then Thomas Willing became the first ever bank president of a bank in America. And then he became the head of. I announced at the beginning of the show tonight. I announced that the first bank of the United States was reopened as a museum. Well, Thomas Willing was the very first president and chairman of the first bank of the United States. So again, this all ties in. Then I had this book, which I thought really fascinating. Steve Jobs in Exile: The Untold Story of Next and the Remaking of an American Visionary by Jeffrey Kane. And this book, just another new book that just came out. Steve Jobs in Exile. I thought this book, I haven't read the whole thing. I've gotten through most of it, but just really, really good, really interesting, really examines that part of Steve Jobs' life that was really critical, like where he really had to re-examine a lot of the things that was going on in his life. He had to look at, well, why did things fail for me at Apple? Why did things really go sideways for me at Apple? And how do I correct that? How do I change that? And I think Steve really did grow, not only as an executive but as a human being in that period at Next, when he was dealing with not only with Next but with Pixar and other things. So it's just a very interesting time period. And then you see, coming out of that quote unquote exile, how Steve was able to come back to Apple and then lift Apple back up and turn it into the company that we know today. So again, I thought it was just very interesting book there. And then finally, 1873, The Rothschilds, the First Great Depression, and the Making of the Modern World by Liaquan Ahmed. Great author, Pulitzer Prize winning author here. This was his brand new book. I did not get a chance to read this yet. This is definitely one of the next ones on my list to read through here. But this just came out. A really interesting. It seems like a really fascinating, interesting book. 1873 was a fascinating year with in politics and in the financial crisis that unfolded. That was panics back in the 1800s. They called those panics, not a depression, not a recession, but panics. So the panic of 1873 was a big one, and very interesting time period to cover. So that's my summer reading list there for everybody. I hope everybody will go and check out these books when they get a minute. But I'm going to, let's see here, gonna get out of that, and now I'm going to get back to our articles here. Where we do here, that is where are we at here? Are we at here? Yes. Here we go. Okay. All right, get back into articles here. All right, so I think I covered that. Let's get back into bank. Are we at bank earnings here? Yeah. All right. So bank earnings. So we're gonna go bank earnings. I'm gonna talk about troubles with the consumers for like the last half hour here. I'm going to get into some of the AI conversation. Then I have a couple of articles here to end up with at the end. But just wanted to spend a couple minutes here on bank profits surge after a red hot quarter on Wall Street. Jamie Dimon said conditions were nearly as good as it gets after JP Morgan reported a big jump in profit. So basically what you need to know is that every bank basically just doing great. JP Morgan, Goldman Sachs, Bank of America, Citibank, and Wells Fargo collectively earned more than 49 billion, a 39% jump from a year ago and above analysts' estimates. Their combined revenues rose by more than a fifth. The results were also strong across consumer businesses, showing the U.S. economy continues to benefit from resilient households and optimistic boardrooms. It's getting close to as good as it gets, JP Morgan chief executive Jamie Dimon said. We just don't know how long it's going to last. So then equities trading, obviously a big part of these profits were in trading, not necessarily in like lending money and other fees, but trading. The trading business was very good for all these banks, except for Wells Fargo, which probably does the least amount of trading of any of these banks. But banks reaped the rewards of the historic initial public offering of SpaceX, with other blockbuster stock market debuts, such as OpenAI, in the pipeline. Goldman led the SpaceX IPO, which helped the bank more than double its fees from equity underwriting to nearly $1 billion. Even without SpaceX, U.S. IPO proceeds more than doubled from the second quarter of 2025, according to Moody's ratings. The volume of mergers and acquisitions industry-wide in the first half of the year was up by 72% in the U.S. and 45% globally, sending both to the highest level on record in deal logic data that goes back to 1995. Still, Diamond pointed to inflation and big fiscal deficits as risks that are shifting below the surface like tectonic plates, and bank executives noted corporate chieftains were still exercising some caution because of the war in Iran. We can't predict what will happen next in it, and that could affect the market's perception, IPOs, etc., said Bank of America CEO Brian Moynihan. So shares of the banks, as you can imagine, went up very nicely on all this news. But then we go into this. Banks are on a Goldilocks run, but don't assume it will last. Virtually everything worked in big banks' favor in the second quarter, but there's no shortage of things that could go wrong. So in the stock market, nobody rings a bell at the top to tell you when the good times have peaked. It is the same in banking, and the times right now are looking awfully sweet for the biggest U.S. behemoths. So again, reported second quarter earnings Tuesday. The results were overwhelmingly positive, although their stock price reactions were mixed. Okay, so stock prices were a little mixed. Goldman gained 9%. Citigroup dropped 5%. All five banks topped earnings and revenue estimates. Each showed improved efficiency overall, with operating expenses declining as a percentage of revenue. Credit losses remained subdued. Some of the numbers were cartoonishly good. That's an interesting, interesting adjective to describe that there. Cartoonishly. JP Morgan's annualized return on equity was 24% when analysts were forecasting 19. It got help from investment gains on its shares in Visa, which was a good problem to have. Goldman, too, reported a 24% return on equity. Then we get to the AI boom. Just found two new winners, Goldman Sachs and JP Morgan Chase. So Goldman Sachs and JP Morgan posted record quarterly revenue as AI-fueled trading, IPOs, debt offerings, and M&A activity boosted equities trading and investment banking. Executives said AI is driving demand for financing worldwide, from data centers and power infrastructure to capital markets activity, creating what Goldman CEO David Solomon called an AI CapEx supercycle. Helping the quarter, investors broaden out their search for AI beneficiaries, pouring money into Asian markets, including South Korea, Taiwan, and Japan. Soufiane Zubieri, president and co-head of global markets at Bank of America, told CNBC. And as we will see here in just a minute when we get into this AI debate, we have really made this massive bet on this AI CapEx supercycle. And the question here is, this is really starting to look like an AI bubble. And the question is, you know, if this AI bubble bursts, okay, that is not going to be good. Not going to be good at all. And the AI CapEx spending has just gotten, in my opinion, has gotten to a level of absolute absurdity. But you can see here, I just wanted to show this because I just wanted to point out what the real drivers of the profitability of the big banks were for the second quarter: is AI-fueled trading, IPOs, debt offerings, and M&A activity. Those are the big items. basically boosting. It was basically all investment banking that was really boosting the big banks here. So, all right, and then we get in Morgan Stanley posts record quarterly revenue and profit as equities trading surges 69%. Again, trading doing really good there for Morgan Stanley. Now, okay, so second quarter earnings for banks, great. There you go. Now we get into a couple other articles here, some interesting things that happened here over the last week or so. So Stripe and Advent make a $53 billion takeover offer for PayPal, sending PayPal stock soaring. So Stripe and Advent are planning to buy PayPal for $60.50 per share, CNBC confirmed. The deal would value the payments company at more than $53 billion. PayPal has struggled to stand out in an increasingly competitive financial payments landscape. So, Stripe is another fintech company. Advent is a private equity firm. It's kind of interesting that they want to go into basically like this partnership here to buy PayPal. I thought that was kind of interesting. Now, I will tell you that since this was announced on Wednesday, PayPal has pushed back, not on the sale, but they've pushed back on the purchase price. They basically saying that that's $60.50 per share, and that ain't good enough. They're going to have to make the offer a lot. They're going to have to enrich that offer, make that offer a lot better. They're basically saying that Stripe and Advent were undervaluing PayPal, which may or may not be the case, whatever. But I just wanted to state that PayPal was pushing back on this. And I think this was interesting because we heard overtures probably about a month and a half ago or so that somebody was looking at buying PayPal, but we weren't really sure who. Now we find out that basically it's Stripe and Advent are looking in here. I'm kind of surprised because I really thought that there were some more obvious, acquirers out there. I thought, hey, maybe Coinbase, maybe Robinhood, maybe somebody surprising, like maybe like a Charles Schwab or somebody like that. But I thought that there were definitely some other bigger companies out there that would have been more interested in taking over PayPal. And maybe they were. Maybe it's just Stripe and Advent made it public. And who knows? Maybe this will cause another one of those big players to come out and make a competing offer for PayPal. We'll see. But like I said, it was interesting development. Then we go into this. So SoFi, not that SoFi wasn't making small business loans already, but we get into this. So need a business loan. So SoFi now offers up to $250,000. And here's how it compares. So SoFi offers a fee-free small business loans, but competitors have higher funding limits. So basically, they're just going up to like $250,000, but the loans come with no application or origination fees and fast funding, but they may not be the best fit for every business. So here's how SoFi's new offerings stack up against other small business lenders. So like when you go down here, so they are offering expansion loans for growing your business, working capital to run your business every day, payroll financing to cover payroll and invoices, and startup financing too to get started. So loan amounts are $2,500 up to $250,000. Term lengths range from 12 to 24 months. You can receive the funding in as little as 24 hours. Borrowers won't pay an application fee, origination fee, or any prepayment penalty for paying off their loan early. There is interest charges on the loan, just like with any other form of debt. Eligibility, much like other small business lenders, SoFi considers a mix of factors for approving your application, including your credit score, business revenue, and credit profile, as well as expenses. The exact credit score requirements were not publicly disclosed. However, SoFi may ask applicants to provide at least 3 months worth of business bank statements to get a snapshot of your business's overall health. Now, how do they compare? So SoFi Small Business Loan is a solid choice for entrepreneurs who need funding to get started, but depending on just how much you need, other lenders might be a better choice. For example, Biz2 Credit offers funding as high as $2 million plus, depending on the type of financing needed. For a financial Fora Financial has financing up to $1.5 million and offers prepayment discounts. So kind of interesting. And if you don't have great credit and still need a large amount of financing, crediblies, small business loans go up to 600,000 and considers applicants with a FICO score as low as 500. So again, very interesting that SoFi has decided to do this. I mean, really, they're really getting competitive, getting hot and heavy. It's very interesting. Okay, now let's switch gears here. A couple of questionable things. So Kathy Rumler is digging in at Goldman, complicating the search for the next general counsel. I'm not gonna spend long on this. I just wanted to say that I think that this is disgusting. I think it is absolutely disgusting. I think the CEO and the board at Goldman Sachs should be ashamed of themselves that they're allowing this woman who was, Jeffrey Epstein's best friend and confidant and attorney to allow her to stay on when we now know a lot of the things that she did and said it's gross. It is just absolutely gross and disgusting. And I hope they end up with a mutiny on their hands over there at Goldman Sachs. I hope a lot of the employees basically stand up and say, no, this is ridiculous. Anybody who was in bed with Epstein needs to go. And she was in, and make no bones about it, she was in bed with Epstein, all of his dealings. It's gross, it's disgusting, and I can't say it strongly enough. Again, do the right thing. Goldman, do the right thing. Get her out of there. Get her gone. Anyway, all right, on to the next thing at hand, the next dirty business, if you will. So we had this joint press statement. So agencies issue a joint statement on handling of highly sensitive information during bank examinations. Now, it's a little interesting. You might be thinking to yourself, well, why? Like, why now? Why would they put this out right this minute? Well, because of this. Former Fed advisor gets 38 months in prison for lying to internal watchdog. A jury found John Rogers guilty of making a false statement, but acquitted him of a more serious charge of conspiracy to commit economic espionage for China. So, yes, so this gentleman right here, John Rogers, a former Federal Reserve official, was sentenced Wednesday to more than 3 years in prison for lying to investigators about sharing confidential information outside of the central bank, in a case that combined Chinese spies, economic espionage, and a blackmail scam involving what photographs. John Rogers, a former senior advisor in the Fed's Division of International Finance, was found guilty earlier this year of making a false statement when he denied in a 2020 interview with the central bank's internal watchdog that he ever released restricted information. But a jury acquitted him of a more serious charge that he conspired to commit economic espionage, rejecting federal prosecutors' claim that Rogers leveraged his access to internal documents, including sensitive economic forecast and briefing materials for Fed rate setters, and conveyed them to Chinese intelligence officers. Handing down the 38-month sentence was the judge. Now, how this guy got off the more serious charge, I do not know, because like I said, it seemed at the time it was pretty clear that this gentleman had given information over to the Chinese. So how he wormed his way out of that, I do not know, but he did. But anyway, so this is what happens. So we got this guy at the Fed who basically was mishandling highly sensitive information. And then right afterwards, we get this. We get the federal banking regulatory agencies today issued a joint statement describing enhanced security procedures for review of highly sensitive information in connection with examinations of supervised banks, such as reviewing materials on site rather than transferring them into agency systems. Because who would have access to them in the agency systems? That guy. The statement discusses a coordinated approach to identifying highly sensitive data and documents, and discusses enhanced procedures for the review of such information to reduce any cybersecurity risks while ensuring that the agencies have access to such information at all times during an examination. So, okay, that is good. And then we go on to now I have a few articles here basically laying out what is going on with consumers. So consumers turn to buy now, pay later for essential expenses with growing risks. A new Lending Tree survey shows that 44% of Americans said they expect to apply for a buy now, pay later loan in the next 6 months, including 13% who expect to take out three or more in that time frame. Some consumers are using buy now, pay later for essentials such as groceries, rent, medical care, and utility bills. The survey shows late payments, fees, and interest can make short term installment loans harder to manage. Yes, and then we go to U.S. grocery slowdown deepens as shoppers buy fewer items, raising pressure on food companies. Yeah. Grocery unit sales fell 1.8% in June versus last year as shoppers cut back, outweighing food inflation. New Bain data shows groceries cost about 33% more than they did in 2019, driving consumers to buy less, switch to cheaper brands, and hunt for deals. PepsiCo, Walmart, and Kroger are leaning into promotions, price cuts, and value as the industry shifts from dollar growth to volume growth. So, and then we get to increasing number of U.S. families took on debt and tapped savings to meet food needs. Over the past 5 years, food costs have risen by roughly 32%. Yes, we got that. And then we go, and now we get to credit card debt. Why high credit card delinquencies aren't showing up at big banks. Lenders' results contrast with measures that show the highest credit card delinquency rates in 15 years. So, yeah, so it's very, I thought this article was very interesting because I've reported on a number of articles over the last 6 or 7 months, and it's very interesting because there's this constant back and forth where you'll see one article that will say, oh, credit card debt is continuing to spike, it's continuing to rise, delinquencies continue to rise. And then you see these other articles where they're like, oh yeah, delinquency's not bad, it's okay. The big six credit card companies are all doing all right, no problem. But what you're finding here is that the actual credit card delinquency is at a 15-year high. Delinquency rates are very, very high on credit cards right now, but they are banks are doing what is called window dressing. They're doing window dressing on the financials, as it were, and they're basically saying, "Oh, well, this person didn't pay us. This is kind of a charge off, a non-performing asset, an NPA, and therefore we're not going to count that. We're not going to count that in delinquency. So we're just going to just take that out of the picture, and that makes their delinquency numbers look a lot better. That's what basically has been happening, and that's what this article shows. Then we go to this. Home buyer affordability slipped for the fifth straight month, a real estate index shows. So the income needed to qualify for a mortgage on a median price single family house of $446,000 was roughly $109,000 in June, according to the National Association of Realtors Housing Affordability Index. While affordability has improved from a year earlier, June marks the fifth straight month it has slipped. The median price of an existing home of any type reached an all-time high of $440,000 last month, according to NAR, the National Association of Realtors. So, and then we go into economic outlook is worsening and Trump is getting blamed, according to a CNBC survey find. So registered voters remain deeply concerned about their financial future, despite a surging stock market and lower gas prices, according to the latest CNBC All-American Economic Survey. Amid the angst over rising prices for food and other goods, President Donald Trump's approval rating is just 40%, with high negatives on his handling of the economy and the war with Iran. However, the news isn't much better for Democrats. The party has just a 4-point edge on which party should control Congress. So, so I wanted to show that string of articles in the build up to this. So, in other words, let's go back here for just a second. So, consumers, just again, try to take all this in for the moment, right? So, consumers turn to buy now, pay later for essential expenses with growing risk. Then we go to, U.S. grocery slowdown deepens as shoppers buy fewer items, raising pressure on food companies. Then we go to increasing number of U.S. families took on debt, tap savings to meet the food needs. Then, very high credit card delinquency. So buy now, pay later going up, credit card delinquency going up, people buying fewer food items, people having to tap more debt to make ends meet to get there. And the home affordability is not good at the moment. And so the economic outlook is beginning to worsen a little bit, and basically Trump is getting the blame for this. And again, here's my concern on this, and I've said this before. I said a couple of months ago that if the war with Iran had ended, um, I think if it had ended, say at like the end of May, beginning of June, I said, things would probably be okay. The inflation would probably come back down. Things would calm down a little bit. A lot of the other good things that are happening would be okay, and that would play through. But I also said that if this war raged throughout the summer and we get, said if we get to September and this thing's still going on, oh, that is going to be bad. That is going to be very, very bad for Republicans going into the midterm elections. Because people are not going to be happy, because what you're beginning to see here is the effects of the inflation catching back up. Like things were looking, I mean, it's so frustrating because things were looking so good at the beginning of the year. Beginning of the year, President Trump's his first year in office, everything was kind of going according to plan. The economy was starting to turn a little bit, was starting to shape up. January, February, March, things were getting really good, and then they had to go start this nonsense with Iran. And they started this nonsense with Iran, and now the inflation went back up. We had the supply side shock with the energy, with the oil and the gas prices, and the inflation goes back up. And now what was looking good after about 5 months, 6 months, now the real effects are starting to creep in, and they're starting to hit people. And but it's also interesting to note that you have these two different sides to the economy right now. Um you have the rich and the upper class that are doing very well right now. I mean, the stock market's going up. The job market remains very solid. So it's like all that's going well for the bottom part of the economy. The bottom half of wage earnings, things are not so great. They're getting crushed under the inflation and affordability. And you have the younger generation, Gen Z, younger millennials and Gen Z, that are basically, they're really upset right now because they can't buy a house, and they're spending all their money on student loan debt and credit cards and being able to just buy food. And that's not sitting well with them right now as a big chunk, as a growing chunk of the voting base. Yeah, that's not sitting well with them right now. And something needs to get fixed there, because if they can't find a way, if the younger generation cannot find a way to get in on this American dream, if you will, yeah, they're going to sour on a lot of stuff pretty quick, and they might end up in desperation. They may end up going after some things or chasing some things that they really shouldn't, and that could have dire and potentially irreversible consequences for the country at large. So I'll just say it like that. So, but like I said, I wanted to show you that series of articles to lay out kind of what was happening there. So, all right, now let's get into the AI conversation for a minute here. Let's blow through a couple of things here real quick. So, Google DeepMind chief Demis Hassabis, if I'm hopefully saying his name right, calls for the U.S. to spearhead AI standard body. Now, I like this. The boss of Google's AI division on Tuesday called for a U.S.-led standards body to test new frontier models for national security risks. CNBC previously reported that Hassabis, along with other leading tech chiefs, called for an American-led AI coalition at a G7 meeting with world leaders, including U.S. President Donald Trump. The proposal comes as the U.S.-China race to develop and deploy AI models ramp up. So yes, I like that. Now, I did report earlier, just a little while ago, let's see if I could find that. Come on, where is it? Of course now I can't find it in this huge pile here. Yeah, I mean, basically the White House did basically put forward this new golden eagle thing to basically measure a lot of these. I can't find it now, of course. Again, I'm hoping that this is the start of some at least oversight of what these AI companies are doing specifically with these frontier models. They could create it could wreak a lot of damage on the economy. So we got that. Then we go into this. So Chamath says that soaring AI token spend will hit companies' earnings. No bleepity bleep, right? Like we couldn't figure that out, dude. But tech investor Chatham said, "Hey, and if you don't know who this gentleman is, he's a very prominent guy in Silicon Valley. He's made himself a lot of money over the years. They've got a big, I forget what the name of their podcast is, but he does a podcast with a couple other individuals. It's a very big, well-known podcast. But tech investor Chamath said AI usage could negatively impact some companies' earnings. Yes, it will. CEOs and CFOs, in my opinion, probably have no idea how much token maxing is going on inside of their organizations. He is part of a growing chorus of investors and tech executives who are cautioning that the token maxing era is coming to an end. Yes, that would be the implosion of the AI bubble, everyone. He's letting you know what's coming. Then we get to Apple's thermonuclear response to the OpenAI threat. So Apple basically sued OpenAI, and this echoes a familiar playbook, betting that litigation to delay arrival from upending the iPhone error. So what happened was Apple started to get in bed with OpenAI, and then they found out that some of the OpenAI executives who they were working with were basically stealing intellectual property and trade secrets from Apple. So Apple is now suing them. But of course, Sam Altman, the slimy individual that he is, of course, how would you expect? Do you really think he was going to hire honest people to work for him? Highly unlikely. So now we end up with this nonsense. But then now we have OpenAI's growing challenges narrow its IPO window. Yeah, of course. Plus Apple's legal sparring and Wall Street's problem with AI drug discovery. So OpenAI is in an IPO pickle. A year ago, the idea of an OpenAI listing would have had Wall Street salivating, with relatively few reservations about its large financial losses or questions about its leadership. After surviving an attempted ouster 2 years prior, Chief Sam Altman had carved OpenAI into his nascent industry's undisputed king and hitched himself closely to the much wealthier Microsoft to bankroll growth. Things are now looking decidedly less clear. The Microsoft leadership has grown more distant. The company's ChatGPT is no longer the clear AI market leader, and OpenAI has been surpassed in its private market valuation by competitor Anthropic. OpenAI won a court battle with Elon Musk in May, but the lawsuit exposed some of the company's not so pretty inner workings. Another headache arose on Friday with Apple's lawsuit against OpenAI, accusing it of stealing trade secrets. That could rattle investors even if the suit doesn't go anywhere. AI devices competing with Apple's iPhone are a big part of OpenAI's growth strategy. So I think that unfortunately the idea of the OpenAI IPO is getting less and less by the day. So, okay. Then we go to current and former employees sue Meta, alleging discrimination and using AI to conduct layoffs. Really? Huh. A group of current and former employees sued Meta, alleging that the social media giant used artificial intelligence to conduct layoffs and discriminate against some workers. The workers allege that Meta's constellation of internal artificial intelligence systems failed to take appropriate absences into account when determining which employees to cut. The lawsuit comes nearly a month after a federal judge in California ruled against tech firm Workday in a separate employee-related lawsuit involving the use of AI for hiring decisions. So very interesting. Then we get to TSMC to invest an additional 100 billion in Arizona after the second quarter profit soared 77%. So another 100 billion investment from them. That's fantastic. So TSMC recorded over 70% year-over-year profit jump and over 23% prior quarter. The company forecasts third quarter revenue between 44.6 billion and 45.8 billion. That's great news there. The White House made fixing Intel its pet project, and it is working. The chip maker's business is improving with government twisting the arms of potential customers and partners, including Apple and Nvidia. So yeah, so far so good with what the government is doing with Intel. Elon Musk's Memphis AI empire is the epicenter of the data center backlash. So, since Elon Musk built the AI data centers in Memphis at breakneck speed, residents have been grappling with unwanted noise and emissions. Citing SpaceX AI in Memphis as a cautionary tale, data centers related policy proposals, protests, and litigation are underway across the country. Public opposition to data centers is rising in response to developments planned or underway from Microsoft, Meta, Google, OpenAI, and other hyperscalers. So, yeah, so Elon's got some issues there in Memphis. The $250 billion onslaught of AI bonds is testing investors' limits. So, tech giants are borrowing even more than expected, weighing on bond prices. Now, this gets into what I was talking about earlier with the CapEx, the capital expenditure spending of the big tech companies as they are trying to build out the massive data centers that they need. Hyperscaler global bond issuance. I mean, you see here for 25, but you see what they have proposed for 26. I mean, almost $250 billion. I mean, it's crazy. It's crazy. And the bond market is basically trying to say, yo, man, we're getting overloaded here. We're getting overloaded here. There's too much going on. And then what happens here? What do we have here? Data center builders are racing to offload stakes worth billions. Unrelenting demand for computer power has investors looking for chances to own the physical infrastructure behind AI. Now, why do you think they would be unloading at this particular moment? Why, huh? I wonder why they would want to be offloading their stakes and they would be racing to do this. Now, obviously, there's billions of dollars on the table, but I would then turn you to this. So, blockbuster stock sales are threatening to overwhelm the bull market. Companies race to issue shares remind some analysts of later stages of prior rallies. Oh, interesting. So, in other words, the bubble has formed. We are about to hit the zenith, and this thing is about to blow. And, so they're sitting here saying the rush for cash by some of the world's largest companies is putting the long bull market at risk. SpaceX's record 75 billion public offering, Alphabet's 85 billion equity raise, a 26 billion plus sale of American depository receipts from the South Korean chip making company SK Hynix. Investors have been cheering the raging bull market for years, 3 years and 9 months to be precise, with the S&P 500 having more than doubled during that period. Now companies are racing to take advantage, raising concerns that the party could be coming to an end. So yes. So again, just as with all those articles showing you kind of what's going on with the consumer, I'm now giving you an idea of what's going on here with AI. So, so again, going back here, now forgetting this, but let's go back here. So, wait. All right. So Chamath basically coming in here saying that, hey, companies really aren't understanding this token maxing. This spend is really going to hit their earnings. Then we come back down here to, basically, oh yeah, the bond market is being taxed by this $250 billion onslaught of AI bonds. And then we get the data center builders are racing to offload their stakes. And then basically now we got and in the middle of all this, we got all these companies looking to cash in. SpaceX, SK Hynix, OpenAI, they're all trying to get their piece of the pie real quick before the party comes to an end. It's like basically think of it right now, we're in musical chairs and the music is slowing. It hasn't stopped yet, but it's slowing. So that is our AI conversation. So just a couple more things here real quick. So U.S. slaps 25% tariff on most Brazilian goods over unfair trade practices. So again, Brazil continues to be our South American punching bag as relations with a lot of other South American countries continue to improve. Brazil continues to go the other way. So they are our tariff punching bag at the moment, if you will. So Blue Owl investors asked to withdraw $4.7 billion from the flagship funds. Redemption requests declined from the previous quarter, but remained elevated. So that is our Little private credit's been a little quiet here over the summer, but I just have a feeling, just call it a gut feeling, that that is not going to be the case for very long. Wait till after the summer. Let's wait till after the summer. September and October are always the historic months when things pop off, and let's wait to see what happens at the end of the summer. Kroger to buy food and pharmacy retail giant Eagle for 1.65 billion. So Giant Eagle has nearly 200 supermarkets throughout Pennsylvania, Ohio, and West Virginia, Maryland, and Indiana. So yes, so Kroger on the march again, looking to buy Giant Eagle. So then we have Fort Knox, 1 trillion gold stockpile present and accounted for, according to Scott Bessent. Well, thank goodness. If only we could have gotten maybe some cameras in there to see that the gold was actually there. Now, look, I love Scott. Okay, I think Scott has been perhaps the best hire that Donald Trump has made. Scott has done an amazing job over there at the Treasury, and I think he has done an awesome job. I'll just put it that way. But him coming out and making the statement that, like, hey, I went to Fort Knox and I saw the gold and it's all good. Over a year ago, Donald Trump was saying, hey, let's go to Fort Knox. Let's see if the gold is really there. And of course, that got squashed real quick, and that went away real quick. And you have to ask yourself why, because if the gold is there, who cares if he goes? But the gold at Fort Knox has not been publicly audited since like 1980. Okay, we're literally going on like 46 years, almost a half a century since the last time that Fort Knox was publicly present and accounted for. So you can imagine my hesitation when Scott comes out and makes a blanket statement like this. I'm sorry if it kind of falls flat, but I'm going to push back on this and say, no, let's actually go see the gold. Let's get the cameras in there. Let's see the gold in Fort Knox. And let's see if it's gold we actually own as opposed to gold that is just leased out. So, okay. U.S. Mint to produce a $1 gold coin featuring President Trump. The new coinage celebrates the strength of American values, says Treasury Secretary Scott Bessent. So here is the new $1 gold coin. I will definitely be sure to pick up a few of these when they come out. I think that looks great. I'm sure some people would probably disagree, but that's okay. But I can't wait to grab a few of these. So, all right. Trump Media launches paid data service to help Wall Street track Trump's posts. So I thought this was interesting. So Trump Media, the company that operates the Truth social media network, said Thursday it is launching a service known as an API to give customers licensed real-time access to posts from the highest-ranking Truth Social accounts. Other social media networks do the same thing. Wall Street firms use these APIs to get an edge on market-moving information. President Donald Trump makes a practice of posting official information first on Truth Social. His family is the largest shareholder in Truth Social's publicly traded owner. So that's kind of interesting. And the very last thing I have for everybody tonight, our last article anyway, is the SBA and the NSA partner to funnel investment capital into the space industry supply chains. So I thought this was pretty interesting. So the SBA and the NSA signed an agreement to direct investment funds toward critical space industry technologies. The SBA's Small Business Investment Company program reached $53 billion in combined capital during fiscal year 2025. The SBA established new offices for faith-based communities and rural affairs to improve service delivery. So again, very interesting. I think this is cool. Just as the SBA is trying to work more with manufacturers, I think it's great that they're partnering up with with NASA here to basically try to funnel and help out some of these companies in the space industry supply chain. So that is wonderful news. So, all right, that is our show tonight. I'm going to go into wrap-up mode here. So I got to get our story of the week up and our quote of the week up. But before I do that, let me just let me get my banners here. Okay. So if you are listening on Apple Podcast or Spotify, please be sure to leave me a review, as that would really, really help the channel. Make sure to visit thebankernextdoor.com, as we have a lot of great stuff up there on the website. Make sure to subscribe to me on YouTube if you want the latest and greatest announcements, what's going on, anything that might be changing, podcast episodes coming out, all that good stuff. Make sure to subscribe on YouTube to get all those up-to-date posts. You could send comments, questions, or topic reviews to info@thebankernextdoor.com. That's how you get in touch with me. Make sure to follow me on social media. I am up on Getter, X, and Truth Social. Remember, BND is on YouTube, Rumble, and all major podcast platforms. New episodes come out every Monday through Friday, premiering at noon. And then the BND Strategy Room live stream is every Saturday night here on YouTube at 8 o'clock. Soon, very, very soon, to be coming to Rumble and hopefully X, but we'll see. We shall see on that one. So, all right, let's go to our story of the week and quote of the week. So, first up, story of the week. Modern monetary theory, MMT. Modern monetary theory is a heterodox macroeconomic theory for countries with complete control over their own fiat currency. Government spending cannot be thought of like a household budget. Instead of thinking of taxes as income and government spending as expenses in a checkbook, MMT proponents say that fiscal policy is merely a representation of how much money the government is putting into the economy or taking out. In this way, MMT sees fiscal policy in a similar way to how we now think of monetary policy. This means that any government spending can be paid for by the creation of money, with the purpose of taxes being to limit inflation by controlling the money supply. This means that spending shouldn't be determined by deficit levels, but by whether or not spending is keeping the economy at full employment and at a reasonable level of inflation. This would turn government fiscal policy into the tool that would fulfill the Federal Reserve's dual mandate in place of the Fed's role in fulfilling it. Now, modern monetary theory was originally conceptualized and developed in the early 1990s by American investor Warren Mosler, alongside American economist Randall Wray and Australian economist Bill Mitchell. While Mosler is credited as the foundational architect, the late French economist Alain Pargues was a pivotal European figure who helped shape, popularize, and expand upon MMT. A professor at the University of France Comté Parcoise, I'm sure I butchered that, worked to build the framework of the theory alongside Anglo-Saxon MMT scholars by integrating it with the theory of monetary circuit and the European socio-economic context. Now, let's look at Frederick Bastiat versus MMT for a second here. So MMT argues that government spending, taxation, deficits, and debts can be managed by experts to achieve full employment and sustainable economic growth without nasty side effects. The great insights of Frederick Bastiat show this to be magical thinking full of errors. MMT proponents' use of accounting tautologies is the pinnacle of bad economics. The equations hide the unseen consequences of giving the government control over our scarce resources. No amount of MMT mimicry can negate the fact that everything comes at a cost. Government spending and taxation divert real resources away from productive uses in the private economy. Likewise, government debt diverts savings away from productive uses. And when the government prints money, it does not add to society's real wealth. Reordering the sequence of taxing, borrowing, printing, and spending does nothing to alter the fundamental nature of these government actions. It's an MMT shell game that deceivers rather than enlightens. If Bastiat were alive today, he would certainly say to MMT proponents, your arguments are fashionable enough, but they are too absurd to be justified by anything like reason. Yes. The reason why I say this is MMT is one of perhaps the worst economic theories to be propagated and pushed upon the world in the last 100 years. It basically is this idea that governments can just spend money into infinity, and they can spend it on whatever they want. Doesn't matter. And then they could just tax and spend, tax and spend, tax and spend. Basically, is the Democrats' wet dream. But the reality is that, again, if we go back to, we look at the U.S. federal debt right now. Oh, we're about 3 months away from hitting $40 trillion in debt. Okay, at some point, this debt has massive real life consequences to all of us. It's like you said, the bill comes due. At some point, you're going to have to pay the piper, right? Like this is a universal truth of the world. So, So yeah, modern monetary theory. I should do a whole episode on that and just it's I hate it. This is horrible, horrible theory. But anyway, on to our quote of the week. So this comes to us from Confucius, from his book Analects. So to study and not think is a waste. To think and not study is dangerous. Yes, we could all learn from that. To study and not think is a waste. To think and not study is dangerous. So, all right, that is my story of the week and my quote of the week. So, with that being said, I thank everybody for joining me here tonight. It was so great to be back here after 3 weeks after being off on vacation for a couple weeks. But great to be back. Stay tuned this week. All new episodes coming out this week, and I will be back here next week in the strategy room next Saturday night. Looking forward to seeing everybody then. Have a great weekend out there. Stay safe, and I will see everybody again real soon. Thanks a lot, everybody.